Fantastic. Thank you for joining us. I know we had a bit of a snafu last week with the timings, probably my fault, so apologies for that. But great to have you back. How are things with the lockdown?
Yeah, not too bad, mate. I mean, to be honest, it hasn't really changed my life a great deal. I've been a self-isolated for quite a while, so when you kind of trading is doing your own thing, it's the little things you miss. It's being able to just kind of do the normal things. But yeah, the reality is that my actual life hasn't changed a great deal. Just have the wife and the kid at home all day now, which kind of takes the fun out of being able to do whatever you want, really, doesn't it?
Yes, you have. Someone's watching now. So you have to sit at the desk all day and actually work. I got you. Listen, Steve, shall we share screens so we can have a look at the markets? People are coming into the room, so while they're coming in, we'll share screens and we'll get started. Yeah, it's called marriage, Steve. Gordon say it's quite right there. So we should
Absolutely,
be
absolutely.
now
And
going.
I don't mind the married bit, but it's kind of, there's a lot more kind of things you can get away with when you're doing things by a phone call or text message. You can't do it when they're sat in the kitchen. So
Yeah, we're all getting found out. Yeah, there's all people are discovering all sorts of new sides to their partners. I, in fact, might be one of the lucky ones. I've been locked down about 1,200 miles away from my wife, who is still on the island of Jersey, of course, which you know Jersey quite well, Steve, as well.
I do, mate. Yeah.
And we've been having a sort of a year of commuting and so forth, but inevitably it would happen that the lockdown would come when she was away in Jersey. So, thank goodness for WhatsApp and things like that. Otherwise, it would be a long time. Right, I am looking at your.
It must be difficult, I feel for you.
It's yeah, we'll look forward to things go back to normal. That's for sure. And yeah, it's just one of these things. We'll always remember the lockdown of 2020. This will be remembered for a long time. Anyway, onwards and upwards. Steve, I'm looking at your screens now. We are looking at people might not be aware that you have a particular set of parameters and your own proprietary iView charts. And is that what we're going to be looking at today?
Yeah, I mean, I always look at the markets through my charts. It's just what I've always done. So yeah, you get to see how I look at the market, see again how I use things like Fibonacci, all the kind of characteristics that were highlighted in my book, and the kind of interesting things I'm doing at them right now. I'm launching a couple of funds that are all based around my Fibonacci principles that you see on the charts. So yeah, I mean, let's face it, Simon, I've done millions of these webinars, and what you're actually experiencing tonight is this is my last ever webinar.
Oh, really?
Yeah, so you're the man. You're the man that gets to wave off Steve Ruffley into the sunset. I've done 10 years of it. I've had enough. I don't need. I've not had to do it for years, have I? But I think I did a series with FX Street fairly recently, and I was just kind of got to the point where I was just like, you know what? I've told people as much as I've got in me that I can do. There's so many webinars, millions of views, and a book, and the software and that kind of stuff. I'm like, I just ain't got it in me anymore. I just I'm done.
Take a break. Take a break. Oh, I'm glad you're here anyway tonight.
I couldn't let you down, could I?
Yeah. Well, let's make the most of you while we've got you. What have you been trading? I mean, I asked you on to see, can you sort of start us off this session today with some sort of just a look at where we're up to, because we all know we're in the poo with the markets, but is any of that exciting you? Where are you looking for your trading? What are you advising your members to be doing at this moment?
Yeah, I mean, I think it's this kind of crossover period of the kind of the excitement of something new, and it's like that morbid excitement of people having different working conditions, and people are experiencing different things all over the world. I mean, we're in kind of a weird honeymoon period where nothing really, apart from obviously people getting coronavirus and dying, apart from that small matter, is that nothing's really kind of economically really happened. We had the non-farm payrolls come out at minus 701,000, and that was a clear indication that something bad is happening, but nothing really kind of major's happened just yet. And I think the problem is, because this side of the world, you think about Australia, hasn't had a recession for 30 years. The people have kind of lost the fear almost. They don't understand that markets go up, but they can also crash. and that, you know, what was a good, safe investment like property 5 years ago could be actually a terrible investment now. So the world's going to change, you know, very, very quickly, and it's going to change probably forever. You know, you look at New Zealand, for instance, they're talking about if you want to travel to New Zealand now, you've got to not self-isolate, you have to go into quarantine for 14 days. So you have to actually go into a government facility from midnight tomorrow for 14 days, regardless of where you travel from. So that's the tourist industry. That's roughly about $54 million a day, pretty much done for. So New Zealand, although we're the third safest place on the planet, and remember, I didn't come here out of accident. You know, we you know, I remember having a chat to you in the pub in Jersey, and I told you I was moving to New Zealand. I foresaw something happening, you know, a global credit crunch, you know, a really major, you know, kind of event. I never predicted it'd be a pandemic, but I'm here for the reason that it's 4.8 million people, the same landmass as the UK, and it's rich. So, you know, there's a lot of opportunities here if things do go tits up, which they have. So it doesn't mean that, you know, just because New Zealand's got off relatively lightly, one death, you know, 1,200 or so cases, it's still going to be hit very hard economically. And it's a different makeup to a lot of different countries, a lot of individual tradesmen, a lot of individual kind of business owners that we're just going to see their kind of, you know, livelihood wiped out overnight. So New Zealand is from one perspective, is, you know, quite an interesting way to look at it. But, you know, globally, you know, you've just seen how the world's just turned off overnight. You know, I've got a lot of clients that are pilots, you know, that, you know, have gone from having, you know, good earning salaries to being sat at home, not knowing if, you know, we're going to need pilots in the future at all. You know, that's kind of, you know, the real kind of nature of these things. So yeah, I don't want to kind of like touch the coronavirus too much. You know, it's happened. You know, it is what it is. I think it is the driver of the force of the markets. And yes, you know, you've got the obvious, you know, gold's a safe haven, store of wealth, people pour into gold, but there's more different facets and factors to that. You know, think about, you know, who holds large amounts of gold. Think about countries that are in trouble. You know, they have to sell that gold, you know, to start, you know, making some money back. You know, there isn't the normal kind of market correlations, and the normal drivers don't really exist anymore. You know, we should have learned after 2008 and let some companies fail and let people realign their life expectations. Not everyone can have everything they want, unfortunately. And now, you know, 10 years later, we're facing the biggest, you know, probably correction that we've seen since the Great Recession. And nobody knows any real figures. They're just banding out GDP is going to be cut by 25, 30, 40%. Nobody really knows what's going to happen. And, you know, Donald Trump in his infinite wisdom just, you know, thinks he can open the checkbook, rob, you know, the next 2 or 3 generations of anything they could possibly want, and just stick it into the stock market. Everything will be tickety boo in a few months. You know, it isn't going to work like that. Some industries are going to die, some companies are going to be finished, and they're going to be finished forever. And that's the thing. You know, there isn't any quick fix to these things, and it will be a long, painful adjustment to a lot of people. Not the rich, of course. You know, the rich have been, you know, as I've said in many webinars, you know, lining their pockets for the last 10 years, and they're bulletproof. So it's going to be, you know, your average, you know, kind of taxpayer that's going to be paying, you know, for all these mistakes that the other world's made. And obviously the pandemic is, so it depending on, I'm not going into conspiracy theories, you know, if it's just a natural thing, it's no one's fault, yada, yada, yada. But it is what it is, you know, it's happened, and the world's decided to go on to a self-made, you know, collective recession. It's man-made. You know, everyone's decided to close business and to stop things for public, you know, health concerns, and that stopped the economies around the world. So nothing like this has ever happened. So there is no rule book, and there is no kind of, you know, this is what you should do type scenario. The scenarios that I'm looking at are the ones that I've used forever. They haven't changed, to be honest. Over the last 10 years, the kind of idea of buying the pound low against the dollar has stood me very well. Buying the dollar low against the yen incredibly well, because it's still king currency. You know, it's still the world's reserve currency. It isn't going anywhere, no matter what happens in the US. The euro is still very fractured for me. You know, the eurozone's experienced a lot of problems. Spain, Italy, Germany, France. You know, the most collective deaths. You know, that's in one, you know, kind of one place. So the euro for me is going to come under a lot of pressure over the coming months. Buy the dips in the stock market, although it's very tempting to, you know, sell the stock market's high on bad news. The dip for me is still the trade to do. You know, it's still, you know, when the market goes down very quickly, you know, there's somebody at the Fed, there's somebody in Donald Trump's pocket buying it back, and it's probably Donald Trump himself. You know, he's too much of an idiot to actually do it himself, but I'm sure he's got a team of, you know, very, very clever guys. You know, he's probably in bed with Putin and whoever else is in bed with, but there's somebody there buying plenty of stock, and that's all that Trump wants to see is the stock markets go up. So that's what's going to happen. It doesn't mean that they'll go up and they won't crash, because it's the real argument now. When you've got 26 people that have more money than half the planet, who's on the other side of this? Who's going to beat the Fed? Well, it's the people with all the money. And it's not saying that they're all in the stock market, but the majority of them are heavily invested in the stock market and their own stock. And you've got Zuckerberg, you've got Warren Buffett, you've got Jeff Bezos. These people have billions and billions and billions between them, and they don't just sit there watching Bloomberg like every other muppet going, oh, the stocks have gone down, Jeff Bezos lost 2 billion. Who do you think's on the other side, right? Who do you think's selling this stuff? It ain't your mum and pop investors, mate. It ain't me with my £1 million account. It's it's people that are have billions of their own family offices. These are the things that I've worked with in for years. When we used to knock around Jersey, my wife used to manage 2 Russian billionaires' money. These are the kind of people on the other side, people that have more money than God, and the people that can take on the big banks, the hedge funds, and these are the people that are driving the stock prices down, maybe of their own stock, but they do it in baskets. They do it in kind of other ways to hedge themselves off from the overall risk. So I did write an article about 3 months ago saying why the stock markets will crash, and it's all down to family offices and all down to kind of the 1% of where they've held the money and how they kind of trade now. And it's not for wealth protection like it used to be, it's to make money. So when you see these exaggerated moves in the stock markets, it's because of these large family offices getting together and using it for their own gain. So this is it. It's kind of, it's the Fed versus the 1% and who's going to win. But it's a difficult one to know. I mean, if you try and think about these things too much and too big a picture, you kind of end up going round in circles, searching for some kind of conspiracy theory or thinking everything's against you. All I look for these days, and the way I kind of trade, is look for 20 pips. So it don't make any difference to me. The market goes up, drops like a stone. I'll just do 2 or 3 trades in that. I learned a long time ago that trading's not about being right. It's about being right at the right time. So that's finding little things like the Fibonacci levels, where 50% is the pivot. So I want to buy a dip in the DAX. Well, there we go. I'm buying it at the 50%. I take a little bit of pain, and then I'm out. I've made my 20 pips. I'm a happy man. I want to sell gold high. Well, I'll sell it at the Fibonacci expansion. It gets back to the 50%. That's about 25 pips. That'll do very nicely because I trade big size. So, I'm not doing £1, £2, £3 a point. I'm doing £400, £500, £600, £700 a point. So when I make 20 pips, it's worth having. Again, and I cycle through the markets looking for the same kind of idea. Where is value? Is this high value? Is this low value? If it's low value in the current range, I buy it for 20 pips. Yeah, I don't sell the stocks, even though I could make much more money. I know where it's going to go to, but that's not the way my brain works. So I'm just sticking to very, very, kind of safe patterns that I understand, and just getting involved for value. So I've made plenty of comments over the years about, some of the very rare longer term trades that I've done, and I've called the New Zealand dollar, and that's again just kind of from living here. So I called the demise of the dollar. I called out Governor Orr quite publicly. He didn't reply, but there we go. He's probably busy doing other things. But he said, he's 25 basis point cut after he surprised the market with a 50-point cut, and then said that we won't change that for the year. It's set in stone. Then all of a sudden the coronavirus came and it's slashed rates by 0.75, and it's the lowest in history. So this is, these are the kind of things that when you do come to a new side of the world where their attitude is she'll be right, their forward guidance doesn't match up with the kind of stuff we're used to dealing with in the city. So, things do change very quickly, very fluidly. But as I say, just being able to pick a market going down and selling it or buying it doesn't make you a genius. You know what I mean? It makes you invested in the outcome. What I keep saying is, it's all about, looking and identifying the overall move, which could be up or down, but being involved in the meat of the move and just being right at the right time. So as I say, kind of my idea, of calling the New Zealand dollar down, it was good, it was right. Did I make some money? Yeah, sure. I made a ton of money. But the majority of the money I make is not from just sitting, holding, having my account tied up in a view. It's by taking trades, very small 20 pip trades in and out of the range several times in several markets. This is the kind of thing, what you need to be looking for is this is why I have the chart set up this way. You just bring it down to these views that I've shown on God knows how many webinars, thousands of webinars. Must have done 50 webinars for you. And it's like, this is the direction of the market, it's up. So when it sells, yeah, if it doesn't break and there isn't some new news, it's going to bounce. So it doesn't matter, that everyone's searching for this high, and getting stopped out here and then trying to ride this down. And it's like, yeah, it's going to break, it's going to break, it's the end of the world. And then all of a sudden it goes up here and makes a new high, and everyone's stopped out, and then it goes back and down. All you're doing when you're investing in that kind of movement is tying up your time, your capital, and you kind of your opportunity cost. So again, when you look at the daily, yes, it's clear that the market is down, but it's bouncing, because we know the Fed are going to come and buy assets. We know Trump and his billionaire pals have been promised the earth if they just keep buying into this and making the stocks bounce. But it doesn't necessarily mean you have to be right on direction. You just have to be right on right time for them 20 pips. So this is, again, you're cycling through the hourly chart, the 15-minute chart, the 5-minute chart. There are options, again, to be neutral. You can sell high in the range and then buy relatively low. If you're only looking for those 20 pips, it doesn't really matter where they come from. Yeah, as long as you're buying and selling some sort of value where you can identify it, then that's really kind of where the kind of success has come from. And all the traders I spoke to at the minute, the ones that blow up are the ones that try and hold a trade, especially overnight. And it doesn't take much movement in your account, in these kind of volatile conditions to be stopped out. So the first rule is, don't hold a view of anything. If anything's wrong, just get out and wait, and then try and do the trade again. It's all about taking your money off the table, but limiting your risk. Any trade over about 15 minutes right now is just too much stress for me. I can tell you anything you need to know about the future. No, that's what I do. I predict the future. But I've never been able to make any money really by predicting the future, because I'm not designed to sit and hold a trade for 3 months or a couple of years. I don't have any long-term investments. I just have a ton of cash, and I make my more money from the cash I have. So I use it in the market short term to make more money. I don't want to put my money in the stock market. I don't believe in the stock market. I have no interest in stocks and shares and individuals. I just look at the things as a whole. And as I say, just go back to this basic 8 charts, which I've looked at for since I created them about 8 years ago, and think, where's value? It doesn't matter where the dollar's going to go in the future. You can go up to 120, 150. I don't care. It's like, where's that value intraday? Where can I get those 20 pips? Where can I be in? Where can I be out? And that's really, again, where people are finding the kind of mojo back in the markets right now, because the markets are moving quickly now, and a lot of people now are have lockdown time, so sat in front of the screens, that you can get involved in these short-term moves. And if you do have the right kind of attitude and the right kind of size in your account, and could trade make every pip count by trading the right kind of size, you can limit your risk and maximize your profit by being in and out. You don't have to ride a trend. You don't have to ride a kind of directional move too long, because you just don't need that amount of movement. You're getting the movement really pretty much, I would say, probably 5 times a day in most of these 8 products. You're going to find a trade, and that's all you really need. That kind of makes sense.
It does make sense. But one question I have, Steve, is the 20 pips. What made you settle on 20 pips, and do you change that for any different markets, or is that just an amount that you feel is possible in most markets? How did you come to that level, or is there any science behind it?
Yeah, you think there's some science, wouldn't you? And it's really amazing because the science doesn't really come into it anymore. Again, I'm a big fan of Fibonacci and kind of things working in proportions. But no, just 20 pips, it's just enough. Because when you do, like I said, when you're trading like 300, 400, 500 pounds a point, 20 pips is enough, mate. If you get any more out of it, it's a bonus. But you see, because the 20 pips, you can see the market move in a very quick amount of time, and you can go on side. But if you try and take it over 20 pips, the market starts to take away your profit. That's what I found. So you can be turning a trade that was a scalp into something that it isn't, because you're not taking the money, and then you want that money back, so you turn it into a different trade and you hold it for longer. Then you might go offside, a little bit onside, more offside. There's a finite amount of money that the market will spit out to you in any one of the scalps that I identify. And generally, after 20 years of doing this, it's about that 20 pips. And if you don't take it around that 20 pip mark, you start to give profit back instantly. So I'm getting out before I hit any level, before I hit any kind of point of attraction. I'm getting out, so I'm the first out. And that sounds counterproductive, because everyone's taught, hold on to your winners. Well, no, you're not trading big enough size, because every winner I have is big. And this is kind of really interesting thing, because I've been working on a couple of algorithms for probably the last 18 months or so. And, it's all based around my Fibonacci and, my kind of idea about taking money when it's offered to you the first time, when your trade goes green, and all about kind of trading multiple positions and trading kind of, products together and then netting off the profit and take it. And it's been running for the last 10 days and just one of my very small 40 grand accounts. And, it's made 6% in 10 days. So I'm not saying I'm some, Gordon Gecko genius or whatever, but it's just interesting because I can't trade 20 products at once. I can't trade simultaneous markets. I can do probably 2 or 3 max, and then things get pretty hairy, especially at my size. So this is where I see the markets going in the future. I don't think humans have the ability to trade for probably more than another 2 or 3 years, and then it'll just be you have to invest in funds. You won't be able to actually physically trade the markets as an individual anymore. I think quantum computing and AI and that kind of stuff is going to take over the markets. And I just don't think there'll be any edge for humans anymore. It's already hard enough as it is with the new scanners, the algos, the black boxes, etc. So I'm kind of transitioning now into this idea that I can still manually trade with enough size, because with enough size you can do anything. But that is stressful and it's less enjoyable. I had a swing on gold yesterday that was about 50 grand, and it's like I just don't want to take that anymore. It's just too much. It's just too much hard work. It just isn't enjoyable anymore. But the idea that you can trade lots of products with relatively small size and trade multiple positions opening and closes within minutes and seconds, that's very appealing. So what I'm doing is all the things I've shown you on here. I'm taking that knowledge, taking that understanding of how charts are created and how traders react to pressure and speed of movement, etc., and then put it into a system where that can take over and just trade it multiple times with set rules. And so far so good. It's been relatively successful, but that's what I'm transitioning, because the risk I have to take each day to make the money I need to make, or not need, but the money I want to make, is getting increasingly more difficult. So as I say, I trade without stops. I heavily average. There's old bull traders, there's no old bull traders, and that's becoming quite apparent that the trading's getting harder and harder as kind of technology moves on. So I'm kind of at that transitional point where I think a lot of traders should be looking to automate the systems and have that kind of benefit of even something simple as kind of having an automatic take profit. When you're kind of buying and selling if you trade at market, so you can kind of get out of positions, because right now it's just so difficult to lock in that profit and just stick to that discipline of just making money. And people are just consumed by finding this solution, this charting system, or this trading setup, this holy grail. There isn't any. And people like to slag me off for using Fibonacci. They say it's basic, and I don't know what I'm talking about, but I don't care. I drive a 911. I've got a hectare of land. I live on the other side of the world. I'm right. So I know what's right for me, what makes me money. At the end of the day, what's really difficult for me as a mentor is to put people into the position where they can make money from their experience and how they see the markets. It's not as easy anymore just to kind of say this is a Bollinger Band, this is support and resistance. The markets are so complex with this battle between what's real, what's fake, what's real trading, what's algo trading. And that's really where I think we are right now. Is there's so much information in the world, there's so much false money, this created wealth, this amount of kind of government and central bank interference, that we all know what should happen, but it could be right one day, wrong the next. At the end of the day, as I say, we're in this kind of bit of a honeymoon period. It's not the best term of phrase, with this kind of terrible tragedy that's going on in the world, but we're in this kind of period of probably almost like disbelief that people haven't really learned the lessons from 2008. And when we wake up in maybe 2-3 months time, and there are kind of, for New Zealand perspective, 200,000 people unemployed, and 1 in 5 restaurants is going to go bust, and businesses are finished, no tourists have come for 6 months, and people aren't able to live off the government, and things start to happen, and that's going to filter through to the stock market. So if you want to kind of just a general idea of what's right, what's wrong, what's going to happen, the market's going to bounce up to here, then it's going to crash. Okay, but the market isn't going to make a new high, the market's going to crash. That's all that can happen, because there is no good news, there is no amount of money the Fed can put in, because we can't just, it isn't like 2008, we just put money into the system and a few people lost their job. This is industries that are gone forever. This is people that will not have jobs forever. It's fundamentally changed the way we live. So yes, the good news, bad news scenario is, the bad news is there's no good news. It only gets worse. So stock markets probably get up to, the DAX will probably get above 11,000 briefly, and then it'll crash down to about 4,000, and then it'll go up, and then it'll range. So that's what I think will happen. But as I say, if it happens, I don't know. I don't care. I don't care about the DAX. I've traded it for 20 years, but I'm just interested in my 20 pip movements. I'm not here to say, that's what's going to happen. That's just my view. And, I could be right. I could be wrong. We will have to see. But as I say, for right now, I'm just still buying dips in the stock market. I think that's the trade to do. Not taking too much risk, getting out for my profit, and buying the pound low. The UK is having a tough time of it, but it's an island nation. Again, it can control itself. It's freed itself from Europe. Well, not quite, but it is. So I think the UK pound has got a lot of, kind of merit going forward. And then against it, I think the euro is the opposite. I think it's got a lot of bad things going against it. Remember, I lived in Spain, well, Gibraltar, for nearly 10 years. So I wish no ill upon Europe. I'm looking at this purely from an economic standpoint, from a kind of, future-proofing standpoint. And that's just the way I see it. I think the dollar's going to continue strong. I think gold's going to find it difficult to get above 2,000 because we've had all the bad news in the world now. We've had Trump, we've had 2008 crisis, got this crisis. If gold was going to go up to them points, it'd be much higher than it is now. So I'm just selling gold high because again, I could be wrong. But at the end of the day, I'm not trying to sit here and tell you exactly what's going to happen because that's what people always ask of a trader. It's like, what do you think is going to happen? Is the market going to be up or down today? And I generally say I couldn't care less. I've got an idea if it could go up or down, but then I don't want to kind of, worry too much. I only buy dips in the stock market, not because I think it's going to go up and make record highs. It's just that's the most logical trade to make 20 pips. And if you keep it that simple, and you don't try and overcomplicate it, you just replicate it every day and make money. And that's what I do. I've made trading very boring. I don't enjoy trading anymore. I actually hate trading. And that's why I'm stopping the webinars. I hate talking about it. Right? I can't be bothered anymore. I can't be. I mean, it's boring.
That is the challenge. That is the challenge, isn't it, Steve? Is that to be successful, most people say that you have to just do the same thing, and that's the discipline: is doing the same thing and not getting bored from it. And that's, I think, where the psychology comes into it. We've got a couple of speakers here today. They're going to go into the psychology a bit more, but that's the biggest challenge, isn't it? Once you've learned all the strategies.
The biggest thing is fighting against yourself, Simon. It's kind of, stopping when you're tired and, not doing something that isn't making you money and then doing the things that make you money, even if it's not as exciting or as interesting. And, it's just, that's what I do now. And that's why I turned to automation and, writing these algorithms. I didn't write them. I'm not smart enough to do that. I've got a team to do that. But, that way it's set in stone. If scenario A happens, it does this and it gets this profit or it makes this loss. And it just replicates it. And that's what I love because I love that kind of, because I can't do that. I've had to train myself to do that because I was always like, this is the big one. You've put £1,000 a point on, just ride it for the next 3 hours and you'll be rich. And I couldn't do it because I was like, no, take the money because that's what I'm trained to do. Take the money and then do something else. But, as I say, Simon, it's people that kind of listen to me, it's kind of, they like the idea that you know more than them and that you've been doing it longer and you've got this bit of experience and this is the holy grail that he's going to tell me this, it's going to change my world. That's what I've been doing in the webinars the last 10 years, trying to convince the world that I know more than them. I don't know any more than anybody else. All I know is how to control myself in the markets. I know what makes me how it pushes my buttons, so I know how to get out before it pushes them too far and loses me a lot of money. And I know when to get out and not be greedy. That's it. Doesn't matter about the charts, doesn't matter about the Fibonacci, the book, the 1,400 webinars, the shows I've done with you. None of it matters. The only real art of trading is to know how the markets make you feel and control your own emotions, yeah, and set some basic goals around that. That's it. I could write my book again in basically a paragraph. If you want to know actually how to make money, it's all to do with how you interact with the markets. It's nothing else. Support and resistance, it's all arbitrary, it's all made up. The fundamentals, who could believe any data that's coming out from anywhere or anything Trump says or anything that comes through? It's all nonsense. It's going to move and you're either going to be right or wrong. It's to what degree you're right or wrong. That's it.
Okay.
That's trading.
That's there we are. We heard it on Steve's last possible ever webinar. I'll try my best to persuade you back at some point, though. You know that.
I might come out of retirement, mate. You never know. I might come out, for one final lap around the stadium.
Oh, listen, we've got a few questions just in the last minute. I know it's an awful. We'll catch up awful late. Paresh is saying, Steve, got to go through a strategy. Paresh, I think we've actually just outlined the strategy there that you look for. If you want to go find out any more about the Steve strategies, go to the website steveruffley.com and you'll find it all there. Marguerite, do different currency couples use different Fibonacci levels as support and resistance? Anything on that, Steve?
Yeah, I mean, the whole thing about Fibonacci is you have to draw it from a point, don't you? You have to draw it from a high to a low. So the whole point is picking the right kind of piece of data. So yeah, I can't be bothered going through a blank chart. I've just done it too many times. But you're looking for a strong directional move. So like gold, for instance, the last strong directional move, started here, right? That's where the kind of market got exhausted and went to these highs. So 80% of the time, a strong directional move will chase to 50%. So if I was trading gold right now, yeah, I would be selling down to that 50%. That's where I'd be out. I won't look for it any further. But because that's an up move, then when it comes down, it has to get to the 50%, 80% of the time before it makes a new high or low. So that's just a framework there. So that's as simple as I can make it. That's Fib. Okay. But yeah, different currency pairs move in different ways, but they will have a high and a low. They will have a previous, set of data or a previous piece of movement. And that's the art. That's what people find difficult about Fib, is knowing where to draw it to and from. But then obviously if you have my charts, it does it automatically. So it scans, for a specific scenario and then draws the Fibonacci on for it. But I mean, it's just movement. So the Fibs are what you create them from. They're from a high to a low. And generally the rule is 80% of the time they will retrace that 50% if they don't make a new high or low. As I say, it's all in the Rough Guide to Trading the book. It's all absolutely outlined there, as clear as I can ever make it.
Okay, thank you. Let's go. Gordon is asking, what's the minimum deposit you need for black bull markets? Also, I believe they use CFDs. I've never traded those, guessing they're operated similar to spread betting. Anything about that?
Yeah, I mean, this side of the world uses CFDs, not spread betting. It's just that, that what they do. It's still trading an underlying market. That's all it is. But the minimum deposit, I don't really mind. If you're on the charts, they owe me nothing. You can have them for free. I'm not asked. You can have them for free. So if you want to speak to me and have some of my time, you got to stick, something like $5,000 in maybe, just to show me you're serious, because I'm always happy to sit here and talk to people one-to-one, because I still do meet some interesting people. And my main aim from this is generally I turn one or two people into a money manager or a fund a year. So if you're any good and you can handle trading a bit of size, you could have a job for you.
Yeah, well, there we are. I've just put the website steveruffley.com. You'll get all the software, all the links to black bull markets, all that sort of stuff, I guess.
Yeah.
There. So on the news this morning, Jacinda Ardern is planning opening New Zealand next week. Okay, that might be true. Let's go, because we're just out of time pretty much. David's saying, all the best for the future, Steve. Glad I caught your last ever webinar. I've benefited from them over the years. So there we are. Great. That's good news. David, thank you for joining us. Thanks a lot, Steve, says Gordon. So, okay, well, listen, thank you. And I'll add my thanks to that as well. Steve, thank you for that. Yep, there's the link, steveruffley.com. Jignesh is just asking for it. You should have had that. I will put it here again. Great, lots of great feedback coming in, Steve. Well, have a well-earned rest from the webinars. I of course will pester you to come back and do one, but not in the near future. Let's get on with getting through this crisis first. And,
absolutely, mate. That's the main thing. Everyone should do their bit, and as I say, I'm happy to do my bit, and anyone who wants to do the one-to-one stuff, I'm always happy to extend that. And yeah, everyone crack on, and you have a good one, Simon, and no doubt we'll speak sometime when you're free after this.
Give my love to all the family. So speak to you again. Thank you.
And yours, mate. Take it easy, mate. Bye.
There we go. thank you, Steve Ruffley, for getting us opening for our working lunch. So we're a little bit just behind, but I know that Adam's here, which is great. So we're going to go straight across to Adam and continue our sessions for today's working lunch. Great attendance. Thank you, everybody, for giving up your time. I know that most of you are probably in the house anyway, but I hope you're surviving your lockdown. I hope you're managing to make a bit of money in these choppy markets, and I hope we're helping to give you some new ideas of what to do. Any other questions, don't hesitate just to tap them into the chat box. Anything that we might not be covering or we'd like to see covered in the future, just let me know. Always happy to do that. Now, Adam Harris is here today. He's going to talk to us about a particular set of webinars in particular that he's put together that I'm going to be offering in conjunction with Fineco Bank. As you probably know, that I've been doing a few seminars and workshops with Fineco over the past year, and Adam is doing an exclusive series of webinars starting next week, next Wednesday. So let's go across. Adam, I can see you're here. Welcome. Good afternoon. How are you?
Bring my screen in. There we go. So you should all be able to see my screen now. So yeah, is it not doing it? Should be doing it. There we go.
There it goes now.
Okay, so just making sure it's that one. Cool. Hi everyone. Hi. So yeah, I was just chatting to Simon before Steve came on. So it was hard to listen to. It was a very draining session. I'm sorry, I'm going to be a bit controversial. I found that to be quite hard to listen to. So I don't know Steve. I haven't met him before. So you've known him for quite a while.
Well, this is what we do. We look at everybody's different opinions and we look at everybody's different thoughts, and that's where I think the value is in these sessions, is because if we were all telling the same story, the markets wouldn't be much fun at all. So it's just, and I guess this is what comes out of it as well, is that you have, oh sorry, the webinar's full. That's good. I'll have to increase the number of seats for next week. But the it comes down to what you want out of the markets yourself. I think this is this old cherry of looking at yourself and saying what can I take from the markets. And you know, maybe the world is going to hell. I you know, personally, I don't think so. I think we'll come back from this, but I think things are going to change. I think there's a lot in what Steve's saying is probably true, but you know, there'll always be opportunities for us. And I think, you know, as small, relatively small traders compared to the professional funds, we will always have an opportunity to sort of get out and get in. It's just maybe limiting that expectancy of what we can do.
Just keep an eye on the time, Simon. What time do you need me to wrap up by?
By 1. I know we've crept into your time.
In 22 minutes. Okay. Yeah. All right, so I'm going to crack on if you don't mind. I'm going to just crack on with that, just so that I can kind of get through the stuff that I have, because I've got 30 minutes worth of stuff that I want to try and do in about 22 minutes, if that's okay with you.
Crack on. Thanks.
Okay, so I am going to be controversial here. I appreciate that, but there's a couple of things that I have to kind of comment from. So there were a couple of things that Steve said I do agree with. I do like, I'm very much a big fan of key levels in the market. I'm very much a big fan of trading in the overall direction, or being aware of what the overall direction of the market is. Looking at different types of markets, currencies. I'm going to tell you a little bit about myself in a moment. I like pivots. I like fib levels. These are all really, really good stuff. And there's a lot of stuff that and obviously, as I said, we have different opinions. There's a couple of stuff I just have to mention here. First of all, I'm really not a big fan of counter trend trading, and that's fine. It has its own reasons. But I think most importantly, a couple of other things, like a 20 pip target will vary from market to market, and I think that's and trading without a stop loss, I think those in the long run are incredibly they're just not successful techniques. But most importantly, I want to say that there are definitely opportunities for trading in the markets. There isn't a time limit on it at all. It's actually created for humans to trade. It's not created for algos. There's a couple of markets where they operate in. They do not run the markets. They don't overtake the markets. There are plenty of markets futures markets. There's just so many, and there's even new markets being created. We've got things like we've got cryptocurrencies. There's a lot of stuff, and there's a lot of opportunities for traders. And actually, so to kind of put it bluntly, that's crap. That's complete crap. At this point in time, there is no indication that there aren't trading opportunities for the infinite future, because it makes a lot of money. And so basically, it isn't just they make a lot of money from people participating, and if people decide not to participate, it's just going to be the computers trading their own stuff. They can only do that if there's other people participating. So it's just not, it's not at all true. So I'm going to stand firm on that one. And so I think it's really important that you guys and girls and ladies and gents who are listening, that the doom and gloom and there's no point in trying and it doesn't matter is just junk. Okay, so just disregard that. It's very much a learnable skill. The markets have been around for hundreds of years, and they will continue to be that, and always continue to be more markets. And the beauty of the way that we trade, for example, is we will always trade in line with the trend. So let's just say hypothetically that the people with all the money controlling everything, all the computers are trading in line with are trading and the market's moving. We can piggyback on that. So basically, we can piggyback on whatever else is happening anyway. It's also worth knowing that computers trade noise really well, but not trends very much. It's also worth knowing that people trade trends better than computers. And the most important thing to understand is that underlying the actual trading, there's an actual market. All right, so there's a market of buying oil and selling oil, and that isn't necessarily, it might be traded by computers, but it isn't driven by computers. Okay, computers don't go, oh, we need more oil, and they don't ramp up production. So just please understand, there's a lot of that stuff that I would discount. Okay, now moving on. So to tell you a little bit about myself, very quickly, so the topic for today was kind of in achieving consistency in trading, but I also want to promote this completely complimentary program that's available, that is that we've developed to kind of show you guys real trading as we go. So it's meant to be practical, real world applications. And what I wanted to do, introduce myself. So obviously I'm based in London. I trade a regulated fund. So these are my returns. You can actually see what I deliver to clients on a regulated account. And this, so these are actual real world signed off regulated returns. So I'm actually demonstrating what I do and what I've done for the last 5 years. So, and this is delivering on client funds in a UK market. Okay, and these are traded on various markets, predominantly currencies, some commodities, as well as indices. Okay, so on my personal trading account, this is me trading other people's money. So that is kind of what I do for a living. That's actually where I make my money. Now, to go back to the slide deck, which is just when I want to work my way through this, and basically there's a disclaimer. Give you a moment to read that before I move on. And so very quickly before I move on to telling you a bit about the program. So there are techniques to achieve consistency. First of all, the first things we want to be doing as traders is trading higher time frames where there's less volatility. 4 hour and daily is really, really good. If our goal is to achieve 4 or 5% a month, which is very realistic, we want to be taking about 2 to 5 trades a week. All right, ideally with a net 1% profit out of that. And so we want to be trading 4 hour and daily initially. That's less volatility, it's slower, it'll help us get there, right? We want to be focusing on mastering technical analysis, which means that we need to be focusing on the higher time frames, at least to get a sense of where the direction is going. Okay, so for example, gold is bullish in the longer run. It's on its way up to 1800 at the very least, and between now and then there may be some potential opportunities. That's an example. Oil is starting to look bullish for the moment. It is still in a longer term downtrend, but it is still looking like it wants to work its way up to 42, and so there might be intraday trading opportunities on that, for example. We want to be focusing on 1 or 2 strategies. We should only be trading trending markets. We shouldn't be trading ranging markets. The reason for this is it's safer trading trending markets. The probabilities of us making money, of the market going where we think it's going to go in a trending market, is infinitely higher compared to a ranging market. Not only that, but and so the potential reward on a given trade is higher, simply just because of that. We want to be keeping a journal. So journal would look something like this. Okay, so it would show the trade I take, my entry, where I get in, what I'm risking, do I take profit at 1-to-1, what was the actual setup that I saw, then obviously what does a higher time frame look like, and what was the subsequent outcome. So this is what an actual trading journal looks like. If you're trading a regulated fund, you want to be able to justify why you took a trade. It should make sense to people. So this should be an example of why I take a trade, and obviously I want to trade it in the direction of the trend. here was a Dow one, for example, that was near the top that didn't actually trigger ultimately, but that was why I wanted to take the trade, and it just never triggered. Okay, so it didn't happen at all. Kiwi one, beautiful trend, and a lot of these made some really good returns. Okay, some of these had some really, really good moves subsequently down. So, and these are all, I mean, I think just that week, I think I did 6% because there were a lot of setups. There were a higher number than average setups that week. And that was just on end of day stuff. It was really cool. So we want to keep a trading journal, and that trading journal should be a record for us and for other people as to why we like to trade, why we took it, what was the outcome, whether it's a winner or loser. We want to do that. But we should be winning about 60 to 80% of our trades should be making money. All right. And the losing trades should generally be technical losses. And obviously, if we can connect to the mentor, that means somebody who can give us objective feedback as to how we can do this. We want to be ignoring the news. Okay, the news largely, and I'm not referring here to economic calendar news that will disrupt the market on the lower timeframes. I'm saying that we don't want to get a bias in our head as to the world is doomed because of this and that. That is absolutely ridiculous, and we don't want to be doing that. Okay, the markets is purely a human-based thing. If you live in the jungle, you're completely unaware of this. I know that it's as important as we attribute to it. Right now, we have a real-world threat, which is a virus. We don't, the market is not a real-world threat per se. It's a human-created intellectual masturbation type thing. Okay, so we don't want to obsess about that. We really don't, and that messes with traders. This thing is probably the single biggest cause of madness in newer traders, so they should just ignore it. So what is the webinar series about? And obviously Simon will come back with questions. If the question is time sensitive, Simon, just let me know. So here's the agenda, right? So basically we've created a real world technical trading program for Fibonacci Bank. This is thanks to Simon driving this. And what is it about? Well, currently it's 6 online live webinars. We had planned a live seminar in London, but obviously we don't know where we're going to be in July, so we don't know what the story is there. These webinars will cover real world approaches to trading the markets. We'll do live market analysis, and if there's trades that I see, I'll be showing you my entry, my stop loss, and how I manage the trade to close. And the trades will actually make sense to you. The market will be trading, price will be against the support resistance level, maybe a Fibonacci level. I'll be telling where I'm getting in, where I'm getting out. It will actually make sense to you, and trading should be rational and sensible. All right, it's not drama driven. So what's really required to trade for a primary or secondary income are practical stuff, ladies and gentlemen, and live up to the day hour market analysis, or day or hour, meaning just that we will look at the markets live and you can see which ones I'm following. So who's it for? Well, it's anyone really who is interested in learning to trade for themselves, who knows nothing about trading. Obviously individuals at the start of their journey. I think also individuals who've been dabbling but not really getting consistent results. And I want you to get to a place where trading makes sense to you. And absolutely what it is not about is listening to the news. That's very important to emphasize that. And of course, anyone who wants to see how it's actually done. So what's best for you? We'll talk about what kind of content's included. You can actually decide whether you like day trading or swing trading or position trading, because you'll understand why you would prefer it. You can change between them, because the strategy, if we do a strategy in it, you can apply that strategy on multiple time frames in any market. All right, so we'll go through the markets there. You can get me to, if you want me to have a look at market, we can do that, or I'll show you the markets I'm looking at. So we'll talk about trade management techniques, how to actually improve our results, and I'll give you guys a trend-based strategy, and we'll do some live trades if we could do that. Okay. Professional approaches, things like habits and psychology of professional traders. It is actually 80% technical analysis, and then it's 20% psychology. As you get more and more mature as a trader, the psychology is less of a factor. In the beginning, the psychology is more of a factor. So maybe it's a 50-50 thing, but it's not most of it. All right. Basically, it is understanding why we're taking the trade and then being disciplined enough not to mess with that. So yes, the markets don't know we exist. They don't care about us. That's absolutely true. And therefore, we decide to interact with the markets and we get in and out. And absolutely, that is on us. That is true, that is on us. But there is actually a skill to this, and we can learn it. So I want to talk about technical analysis done the right way. And so these are sample slides from the program, things about where in the journey you are versus wrong intuition, wrong analysis, right intuition. These are very important things to be able to determine. I'm going to be covering all of these different technical skills as well, how to do them properly, how to do them the right way, sample slides again about how to identify the actual market conditions you should definitely stay away from, where there's no money-making opportunities, and markets that you should be taking a look at. And then we'll talk about where to get in, and we can look at some historical trades. But usually there's actual trades that we can either look to trade or they can go on my watch list. So things like mastering technical analysis, how we go about doing it. These are just sample slides. I'm keeping an eye on the time, ladies and gentlemen. I've got 10 minutes, so that's why I want to be careful with this. You know, how we can actually improve our results, because people talk about winning trades and losing trades, and actually that is oversimplifying it. We can have partial losses, break evens, partial wins. All right, and the strategy I'll give you is a 3-to-1 reward to risk strategy, and it provides opportunities in most markets either every day or every week. Okay, so it's pretty works pretty well in that, and it can be used in multiple time frames. All right, so that's the kind of thing I'll be covering as well, and a checklist, that kind of thing. So going through it, and also how to create that diverse portfolio. How do I reduce my risk? You know, how do I see what's going on? And this is more of an approach that the professionals have. This is trading. It's not investing. This is how to go about earning a monthly income from trading the markets as opposed to investing in the markets. If I was going to invest, so a portion of my profits should go, a portion of everybody's money should always go into the markets, always. Stock markets are one of the best ways to create real wealth, and there's nothing stopping us from piggybacking on Warren Buffett's stuff. We can do that, so we can generate wealth just the same way they do, and anyone who tells you differently is selling you snake oil. So we can absolutely do that. So we can trade different markets, and we can select markets based on really opportunities that are there. So for example, if I was going to buy into a stock, what stock do I really like that actually should make sense to you, ladies and gentlemen? Let's go through and have a look at an actual market, blah, 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 blah. So one of the ones I really like at the moment, example, is Costco. This is beautiful. So Costco is a worthwhile buy. It's completely recovered. This is the result of the last couple of months. Why does it work well? Well, because obviously people are cutting back on budgets. So then there are businesses that thrive during a recession. So yes, there are money-making opportunities even during a recession. And the technical skills that I cover in the program would translate through to buying shares or owning shares on in terms of stocks. So I also am going to cover the differences between the technical natures of currencies, commodities, indices. Why, what are the differences between them? Currencies do not trend as well as stocks do. So stocks are actually easier to trade. Commodities can also trend incredibly well. This is a general application, and currencies can do shorter term trends or longer term trends, but we have a different approach with those. So there are differences in the way that they behave, their personalities. And then we'll look at charts with actual real money making opportunities. And this is going to be running over a couple of months. So you'll get an actual opportunity to see for yourself, in other words, evidence-based trading, how we predict the markets are likely to go where they're going to go, where the probabilities that the market is likely to go in one direction is much more likely than going against it. And I'll also talk about how we identify when a trend is going to change. Obviously, the biggest fear is going to be, well, I finally discovered a trend, and then when I got in, the trend changed. And a big part of that is really knowing how to identify the trend is running out, where it's going to run out, and also managing our risk. And this is why every trade we take always has a stop loss. But this important thing is, where do we put our stop loss? If we put our stop loss in the right place, it cannot get touched unless the market actually goes there. And that in itself is a signal that we want to get out of the trade. And keeping a trading journal is really what's going to help us on those days when maybe we have more losers than we did the previous day, so our self-esteem and our confidence is lower. The trading journal is going to remind us that it was a good trade setup, even if it was a losing trade, and it's going to remind us that we're on the right track. So we need, as traders, we need to be able to monitor our progress. We need to be able to monitor that. So what are the dates for this? Well, these are the dates. I would recommend that you snapshot them if you can. The plan currently is to start at 7 p.m. on these evenings. If everybody's home, Simon, it might be worth our while to consider starting earlier. This is before we were trying to allow for people to commute to get home, but I actually think we should consider starting much earlier, like 5 o'clock or something, if everybody is home. Simon, it's just a thought. I'm just having it right now.
And just on that, Adam, there's one date, the 15th of April, in fact. So
okay.
Yeah, you just missed off the first date from that list. It's the 15th of April. It's next Wednesday.
Sorry, yeah, 15th. Okay.
Yeah, no,
Oh, yeah, sorry, I missed that. I beg your pardon. Okay, so there's a 15th of April that should be here. All right.
Well, the link is there in the chat box. So you just jump onto the Fineco website registration page and register for that first webinar on 15th. Sorry, Adam. Yeah.
No, I'm actually, this is it. So if you want to know where to sign up, obviously you can head over to the Fineco page. So the whole idea was that Simon and I have been talking about this for a long time, and we've been wanting to put together effectively a program that would allow people, but you've got to be following it from start to finish, because each episode is part of the building blocks of success, and it's meant to be practical. So, and this is the thing, is that I find a lot of stuff out there sells too much voodoo and smoke and mirrors, and trading is actually much more logical, much more rational, much more practical. And this is just what I picked up from trading in the city with London traders. The other thing that I should tell you, and I think this is really important, I don't know if I mentioned this to you, Simon, but I meet with people in the city all the time, big institutions, and the outside perception is that all of them know what's going on with the market, and they all have their own quant equipment and whatnot, quant algos running, trading the market. But there's very few. London is incredibly old-fashioned. It's still seen as the financial capital of the world, and it's very old-fashioned. And there are very few companies that I know of that are really breaking ground with that. A lot of them are doing kind of very much old-fashioned approaches to this, and the old-fashioned traders love their pivots and fib levels. So my point is that I think people are scared in a way that this technology is running away, and it's really not in that sense. It may be occurring in maybe parts of the US or maybe parts of China, absolutely, where they've got the skills to be able to develop those programs. But we have to remember that the market's always based on supply and demand of an actual product underneath that. And if that isn't used by humans, the market doesn't go anywhere. So we just need to calm down and understand that there's a lot less voodoo and conspiracy stuff out there than, that's the case. We do, on the other hand, have a real world danger where, for example, Trump is, you're kind of, and this is going to sound, I'm going to sound like a hypocrite. This is going to sound like conspiracy stuff, but you're looking very much at pre-Hitler Germany kind of stuff happening in the US with the Republicans and with Trump trying to control voting and break the laws and remove that kind of stuff. And so that the Republicans ultimately want to be the only party in control, and that's really actually is the case there when you consider laws that are being changed and disregarded. So that's a real concern I have, because the US economy is the biggest in the world, and it is, it's absolutely huge. The UK is 2.9 trillion. And the US is sitting at about 24 trillion. So the US economy, and China is not far behind at about 14 trillion. So those economies are the ones that can really impact the rest of us. But are there opportunities to trade the markets? Absolutely. Should it be fun? Should it be, do we have to, can we master this? We can. In fact, the problem I find is I have to remove bad ideas that people have. I spend more time removing funny ideas that people get in their heads than anything else, bringing it back down to practical stuff. Sorry, Simon, I'm completely open to questions now, and we have 2 minutes to spare.
Not at all, Adam, that's fine. So does anybody have any questions, particularly for Adam? I know we cut into your time at the start, and we've had to race through the slides. David, what time zone is used for the 7 o'clock webinar? Is UK British summertime, David. So if you can adjust that for wherever you are in the world, that would be super. But yes, it should be good. And that final seminar in London that you mentioned, the series will work up to that seminar. I'm still confident we'll be able to run it. I think we'll probably be over this. I'm optimistic, anyway, fingers crossed. But if we don't run that, I'm sure we'll do it online. But if we do run it and you can't get to London, don't worry about that, because I'm trying to persuade the chaps at Fineco to live stream it as well. So we'll have a camera absolutely in the room to live stream that. Stephen says, excellent run through. We'll register this afternoon for the webinar. So that's great, Stephen. Thank you for that. What's the difference between a hedge and an equity fund? Marguerite is asking.
So, well, the whole thing really with the hedge fund is that the laws are different. The regulation laws for them are different. They can short instruments, so they can short the stock market if they want. While I'm on that, I should actually mention, and equity funds would generally be buy only, so they wouldn't really short the market. And the best example of that is Warren Buffett. And actually, if you listen to Warren Buffett and his business partner, when they are interviewed, you'll see that they're I'm much more like them. They're old-fashioned. Making money is a lot simpler than people make it out to be. And he even talks about how hedge funds are not necessarily as successful. There's too much, in my opinion, there's too much dependence on listening to the news and all the drama that's going on rather than practically trading. What is the market doing today? Is it going up today or is it going down today? And that's really what my focus is. I don't need to know what's going on with oil in the bigger picture to be able to determine if it's trending down this week. And so in other words, the analogy I always use is surfing. All right, so if I want to go out and surf the ocean, I must be able to swim. I must be able to identify a set of waves. If it's too flat, there's no waves. If it's too stormy, it's too dangerous, I go out there, there's a set of waves that it's timing. I must get in and ride the wave until it's done. But at no point do I need to understand how the moon and the stars and the rock formations under the water create the waves. That's actually irrelevant. There's other stuff that's more important than that. And so trading is the same thing. I need to be able to identify conditions, identify when to get in, when to get out. And then it's just a numbers game. The better I identify those conditions, the more often I do it, I'm going to make more money than I lose. And it's pretty much that. So it's really, I've got to strip that stuff away. So equities are looking to get growth over time. They will generally be looking to buy and hold as long as possible. Hedge funds will look at multiple markets. They will probably look at hoping that if they've got a position in gold and a position in oil and a position here and there, that they're gaining on net profits, and they'll also in theory look to short the markets. But again, if the market behaved, if it was correlated to what we read in the newspaper, then everyone would make money. The reason the market doesn't correlate to what we read in the newspaper is, first of all, because we make the biggest mistake in thinking that the market moves because of what we read in the newspaper, and it doesn't.
Okay, the wise words. Thanks, Adam. And I think we'll wind up there. If you can, please do jump over to that link that's in the chat box. Get registered for this 6 series webinars that Adam's going to be doing with Fibonacci Bank and myself. I'll be there as well, hosting, chatting away as we do, and well, hopefully you can join us there too. So, Adam, thank you so much for joining us again, and I appreciate that. I'll talk to you again offline.
One last thing I just suddenly realized: if you do find that the page, the Fibonacci Bank website is in Italian, there's usually an option somewhere to change the language to English. If you do find that's the case, so just be aware that sometimes it reverts to an Italian version. Just a thought.
It should be defaulted now to English. That's something that we've rectified. So anyway,
Great.
Listen, thank you so much, Adam. I'm going to take the reins back now, and we'll move over because we've got another speaker waiting to go. So thanks again.
All right.
Here we are. Right, our next speaker, I'm pleased to say, Steve Ward. It's been a long time since we had Steve on one of these round-the-clock trader webinars, and a couple of weeks ago, Steve sent me an email with an attachment. It wasn't even a couple of weeks ago. I think it was maybe just a week ago, and I sent it out to everybody on our list because it was a wonderful PDF e-booklet offering some advice and tips for trading through the markets and keeping your head in the right place, because we're all being faced with unprecedented worries, concerns, challenges. All these things are impacting on our sort of mental health, which is a really key part of trading. So I wanted to share that with everybody, and I got a great feedback from it. Everybody was very grateful for Steve just to send that out there, and it's a super thing. And I said, look, would you like to come on as well? And Steve said, well, fine. He doesn't normally do these sort of things. Of course, he is a mentor, training coach, and it's normally the banks and institutions in the city that have him in to train their traders to handle the big amounts of money, obviously, that they're managing. But I'm pleased to say that Steve has given up some time and he is in here with us. So enjoy. I will unmute Steve's microphone so we can say hello and welcome him in. Okay. Oh, Steve, I think we're maybe, there we are.
Hi,
Okay.
Simon.
Hi, Steve. How are you doing? Sorry, but I think I was muting you, then unmuting you. So my apologies for that. Welcome. Good afternoon. How are you?
I'm very well, thank you. And yeah, thanks again for giving me a slot. Appreciate it. Has been a while.
No, it's always our pleasure. And I'm just telling everybody that we shared that ebook out there. A lot of people have downloaded it and read it, which is fantastic. And I know, just to sort of preface this session, you have also a special online training course coming up, which you've been at pains to tell me, look, this is aimed at the professional traders. And I said, I know we have some pretty sort of savvy traders in the group, so they might be interested in hearing about it. But regardless, we're always pleased to have you on to tell us. And today we want to just get a few tips for keeping our heads clear, I guess, in these difficult times.
Yeah, and that's what I'm going to mainly focus on, Simon, really, is I'll try and give some guidance, much as I've given to my own professional traders. I'll very quickly at the end, just for probably 60 seconds, just touch on the online course that's coming up. And yeah, really, I think, if you've been trading for 2 years or longer, if you're taking it pretty seriously, it's for you. If you're less than 2 years or it's more of a hobby, then maybe it's not. But I said we'll get to that at the end. Can you see my screen, Simon?
No, well, at the moment we're just looking at your website, which I've got up. I'm going to make you the screen presenter now, so you should have a button offering you the chance to become the presenter.
Is it an orange button?
Well, you know what? I don't know what color it will be. It will say.
I've been on WebEx for the last 2 years. I'm not as familiar anymore with it.
No, sorry, it was my fault. I pressed it on. Your panelist. Now you are being offered the presenter role.
How's that?
There we go. Yes, I can see your slide. Everybody else can everybody see the slide? Okay, Steve Ward. Yes, great. Okay, fantastic. So yeah, what I've asked you to do, Steve, I know you've got the training course coming out. Let's touch on that at the end. But yeah, what should we be looking at in particular, do you think?
So I've put a few slides together just to kind of make it a bit of visual rather than just me talking. So I kind of work through the slides with a bit of commentary as we go through. But I think the main thing we have to recognise, and I've got a slide here, is we are seeing conditions in the markets that we would easily classify as extreme. And I think whenever anything is extreme in life and or in the markets, then what we have to appreciate for all of us is that the possibilities of having an extreme reaction to those events is also equally high. So most of the people I'm working with, they are generally experienced traders. They've got plenty of money in the pot as such, and they're well backed financially. So they're often skilled and experienced, but that still doesn't mean that they're immune to these highly volatile, highly uncertain, novel types of situations. So my role really with my clients has been the assumption that they've got the skill and the knowledge to know what to do. So let's call that kind of the craft of trading is high for them. And then my role under all conditions, but I think particularly under these conditions, is how do we make sure that the mind and the body are being optimized to allow that person to make the best decisions possible, to take the appropriate risk. I think also to recognize that the volatility is high. You can be up a lot one day, down a lot the next day, and you need to be quite robust to deal with that. So that's what I'm going to kind of try and talk through a little bit. Really, is about what we can do to manage what's happening. We can't. The first one we'll come to later is it's happening. So there's no point wishing it was different. And this is always my, the market is what the market is. Life is what life is. So we have to accept that this is what it is. I was just hearing Adam, talking about the ocean and surfing, and if the ocean's pretty wild, then that's what it is. And if it was a surfing competition and you had to surf on that day, then you've got to deal with it as it is, or you choose to withdraw and not to surf. So we've got choices, but we're choosing how to respond, even though things are difficult. So I think the first thing I want to say, and this is really important, is just that we all need to recognize that we are all going to respond differently to these conditions. And that's true as traders in the markets, and it's true as people looking at life events. So we have all got different personalities. So on the screen there's something called the risk type compass. I use this a lot as a psychometric test I use with my trading clients. And in very simple terms, if you go from top to bottom, then the vertical axis is kind of from the top, risk averse, to at the bottom, risk seeking. And if you go horizontally, then on the left-hand side, are people a bit more kind of intuitive, a bit more subjective, and on the right, people a bit more objective, a bit more analytical, in very simple terms. And so we've got different types of people, and depending on where you are on that compass as a person, will depend on how you feel about things like uncertainty, how you cope with novelty, how you deal with volatility. People who are very risk averse, very cautious, for them, high levels of volatility can be, a huge threat. Uncertainty can be something that can be kind of unsettling for them. But if you're lower down on the compass, if you're adventurous, then those people seek out uncertainty. They love uncertainty. They like volatility. They love novelty. So we're all different as people, and that's going to affect how we process information, how we deal with things. It's going to affect, the trading strategies that we maybe feel most aligned to. So we've got to recognize not everyone's going to respond the same. And I've seen that in my clients who I've been speaking to over the last 2 or 3 weeks very, very, very clearly. Everyone's also got different experiences. So I've got some traders who are very experienced, 20, 25 years into their trading careers, one of whom I nicknamed the crisis trader. Whenever there's been a crisis anywhere, he's been there, he's traded through it. He actually relishes, he loves these. These are huge opportunities for him. He loves the crisis. In very simple terms, often when we're looking at events, we might filter it on a continuum of being, is it a threat? Is it an opportunity? If it's a threat, we're kind of into risk situation. If it's, and maybe fear might be the emotion. If we're into it's an opportunity, then we're into kind of the reward circuits of the brain, and maybe we can get excited about it. So some traders will have been in this situation and going for it in a kind of a challenge, excited, opportunistic mode. Other people may be on the other end of the spectrum, again, partly personality, partly experience. So we need to be mindful of that. Also, people's trading approaches and strategies, that will factor in how they feel. And if maybe you're more medium term, longer term, that will be a different approach to somebody who's maybe one of my traders who's pretty short term as a day trader. This is like prime conditions. It's never been better for him. Everything literally he could wish or pray for as a trader is happening. It's the perfect match of market to his strategies, to him as a trader and his personality. So it's literally like everything is aligned in a one-off potential opportunity for profit maximization. So, and he's traded phenomenally well. So it's been a great period for him in terms of market returns. For other people, maybe not so. And also context. Are you someone trading from home? It's hobby. It's a bit of fun. Are you someone in a hedge fund or in a bank or commodity trading company? So the context will also impact how you respond to this. And it's really important to recognize that we're not all going to be the same. And so when we're reading guidance or getting advice on what to do and how to do it, we need to be mindful of our own individuality, and what works for one person won't be the right approach for all people. And I come back to that always as a key trading kind of principle. And this is just really, I saw this probably on LinkedIn, I'm guessing, and it kind of stuck with me because it's just a great example of how different perspectives can make you look at things in different ways. And I think what happens in the markets is, and it's why markets work, is because people look at them and they see different things based on your perspective. And that's very true. So who you are as a person, what you trade, how you choose to be during these times is going to have a big impact on how you see things, and then accordingly how you respond to them. So psychologically, that's kind of the framework, and we'll get into some little tools and techniques in a moment. But I want us to also to recognize that it's not just about the mind. So I talk a lot, obviously it's my profession, my passion is trading psychology, but also my passion equally is trading physiology, what's going on in the body. And we have to remember that the mind and body are working together as one system. So when you're making a trading decision, when you're taking a risk, it's not just in the mind, it's a combination of mind and body, and we want to optimize both. Now, under challenging, stressful conditions, obviously the body is taking on more stress. So, trading has what I call the trifecta of challenge, which is uncontrollability, uncertainty, and novelty. So those three components are kind of a constant factor in trading, and each of those creates a stress response in our system. At the moment, obviously, we're in extreme conditions with high uncontrollability, high levels of uncertainty, highly novel, first-time events of this type. Volatility is high, so the body is being loaded up. But at the same time, for my clients, they're also wanting to trade well. They want to try and maximize these opportunities, or be careful not to get caught up in them, which we'll talk about later. But it has a toll on the body, which is important. So on this graph here that I'm sharing, and I've got a couple more to share as well, in very simple terms, red is stress, blue is movement, and green is recovery. So red is kind of, we're on, there's stress in the body, could be fear, could be excitement, but it's an energy in the system. Green is the body switching off and recovering, and blue is if there's any kind of physical movement. And I just share this because this was a banking client, not under the current conditions, but under a previous set of highly demanding conditions, who we had wired up to some biofeedback data, and we can see the impact it's having on his body. Now, you have to remember that the brain is sitting inside the body. It's called being embodied. So the state of the body has a big impact on how the brain functions. And when we are stressed and fatigued, one of the key things that happens is it reduces our mental resources. So our cognitive resources are reduced. It impacts our decision making. We may find ourselves, as we get stressed and fatigued, becoming more short term. We might be more interested in avoiding any current pain or getting instant pleasure. It's harder for the kind of the longer term thinking strategic brain to activate, because that's the part of the brain really which sacrifices resources to enable the stress response to kind of come online. So it's interesting to see kind of in real time just how it impacts us. This was a trader at a bank. This was a client at a hedge fund, again, not in these conditions, but under kind of the most similar ones that I had with data to show. Again, we can see a big impact, lots of red bars, lots of stress. You can see the impact on the sleep. So even when we're sleeping, you know, the body's not switching off. That has a big impact then on recovery for the next day and how sharp we are. This was a portfolio manager, so from an asset manager. Again, you can see equally extreme conditions. We can see the toll it takes on the body. And I think one of the things that I'm doing with my clients, which is really important, is I've advised all of them to pay specific attention to the body. Because there's a lot of controllability about what we can do in terms of lifestyle habits to manage our stress and fatigue levels, and I'll come to some of these in more detail in a moment. But it also, I believe it's hugely impactful. You know, as we get stressed and fatigued, the brain is looking for the quickest, simplest, easiest decisions to make. It doesn't want to grind out lots of analysis. We're more prone to bias. We're more prone to error. And in the conditions we're in, that can be extremely costly. So almost like the baseline really to get right is the physiology. If you kind of look after the body, then the mind can immediately operate at a better level. And then we can kind of finesse the mental and emotional skills on top of the physical and try and make the best decisions possible. So and this is just, again, it's not under these conditions. I've not had anybody wired up specifically. It's been a bit challenging as it has been without wiring people up. But this was a day trader. And HRV is heart rate variability. It's an objective measure of the state of the nervous system. And that number is dramatically affected by our levels of stress and by levels of energy or fatigue. The higher the number is, the better. So this was a client, and I've seen this in my own clients this time around, is when there's periods of high opportunity or perceived as high opportunity, people don't want to miss out. So FOMO, fear of missing out, has been high during this period for some people because they see it as a huge opportunity, possibly once in a lifetime, or certainly, not going to come along that often, and they don't want to miss out. So people are working longer, they're working harder, and there's some good to that, there's some bad to that. It's a balancing act, really. But what this data shows is that when you are working longer and harder, there is a cost, and the cost is on your physiology. So we can see that on the first day, after one, so the baseline number before this was around about 60. After one 14-hour day, we get a drop to 53. That could be perfectly normal, nothing to worry about at all. Next day, we go down to 45. So from 60, that's quite a big drop down, 25% drop. And then as we go down to the third day, this is where it really starts to take its toll. We can see now down to 26. That's half of the first number, and it's under half of baseline. So that's a significant drop in body resources and physiology, and that will impact how people respond. And actually, what it will do is when our physiology is low, it's very hard to respond because we go into reactivity mode. When stress is high, when fatigue is high, then reactivity increases. And what we want to be as traders is responsive. We want to be situationally aware, watching the market, seeing what's happening, checking in against our trading process and our principles and who we are as a trader, who we want to be as a trader, and then making best choice of action in that dynamic and moving environment. Situational awareness, the ability to monitor externally what's going on and internally, reduces under stress and fatigue. So it has huge implications for how you process data, how you take risk, and how you make decisions. So what I've done, I'm going to share a few examples and some, I guess, tools, techniques that I've been using with my own clients. These are not, I'm saying, for everybody. For me, it's always each trader operates in a context. You've got your own unique philosophies, principles, a purpose, outcomes you want to achieve, strategy, styles. So you've got to kind of filter it into your context, take on board what's useful. But I think it'll give you an idea about some of the things that some of the professional traders have been thinking about and mindful of to optimize performance during these times. So the main message is we are in extreme conditions. There will be an impact on the mind and on the body. The danger is we become reactive, and what we want to be always is responsive. So we're looking to increase the possibility of being responsive. Now, the Navy SEALs have this great phrase, which is about under stress or pressure, you sink to the level of your training. So we have to remember, the phrase I've been using a lot is, how you deal with each moment in the market is really a reflection of all the moments before that moment. So, in a stressful, challenging moment in the market, what's going to determine whether you make a good or bad decision is more about all the things you've been doing before that. How well trained you are, how experienced you are, whether you've been working on your mental game as well as the craft, whether your body's in good shape. So all of that is really going to have much more impact on what you do in that moment than anything else. No fancy hack or technique is going to save you in a moment of high stress if you are underskilled, underprepared, lacking in knowledge, taking too much risk, etc. So that's always the key thing. And the one message, and it's interesting because I had this with one of my clients that we started working on last year, was preparing for significant market events. So with him, we've been working on for 6 months before the virus took effect here in the UK. We were already thinking about if there are going to be major events in the market. One of his goals was to really maximize those opportunities. That was our kind of coaching goal. So we've done lots of work on what do you need to do to be ready. How do you identify it? How do you make sure you're ready to take the opportunity as it arises? And that should be an ongoing piece of work for all traders. How do I make sure I'm ready for when these moments occur? We don't know when they're going to happen, but we want to be ready when they do. And that means doing a lot of work and, unfortunately, often with little immediate reward. But that's what it takes to be a great trader. So the first factor, I'm going to break it down into 3 chunks. Hopefully this is helpful, is to accept the conditions as they are. Now, that might sound a little bit obvious, but there are some people who, when the conditions in the markets aren't as they would like them to be, spend a lot of time complaining or talking about or sharing commentary on the fact the markets aren't as they would like them to be. Can you control that? No. If you can't control it, then any time or energy spent dwelling on it, worrying about it, complaining about it is utilizing valuable resources that you can use elsewhere. I use a little framework called the CIA: control, influence, accept. So can I control it? Can I influence it? And if I can't control or influence, then I should be looking to accept. That's my kind of little framework that I work through with clients. So you can do it for yourself. In the current conditions, what can you control? Where can you influence? What are the factors outside of your control that you need to accept? And what I'm saying is recognize where there's controllability, recognize what you can influence, and recognize that the number one thing that you can control is how you respond. Nobody's chosen these market conditions. How we respond to them is going to define what happens as you go through them and as you go beyond. So that's kind of my first key part: acceptance of the conditions. What can we control? How are we going to respond? Second part then is recognizing this. When we're in extreme conditions, and obviously it's on a sliding scale, so a continuum, as the conditions become more extreme, more challenging, more demanding, and more difficult, it is perfectly normal and natural that thoughts, doubts, worries, anxieties, stresses, and fatigues will show up. And they show up because it's the human condition, and that's how we are, and that's how our body works under those conditions. So a lot of traders have had, you know, different thoughts, both highly optimistic and almost euphoric about the conditions, or very fearful, all through the spectrum. For some of my clients, it's been more about, you know, jobs and roles rather than actually, you know, market returns, and also worries about, you know, people at home, you know, worries about the family, so wider worries. So a lot of these thoughts and the emotions that show up, they're not bad, they are normal for the situation, but what they can be is unhelpful. So in my model of psychology, we're looking to develop psychological flexibility. We want to recognize that when it's difficult, thoughts, emotions might show up. This is true, you know, if you're offside in a trade, if you're making money in a trade, if you're looking getting into a trade after a loss. It's perfectly normal that difficult thoughts and emotions show up. That's the human condition. What you want to get skillful at is how you manage them when they show up. So the first skill of being able to manage emotions and thoughts and physical sensations like fatigue and stress is you need to be able to notice them. So I do a lot of work with my clients around how we can develop awareness of what's happening to our mind, to our thoughts, to our emotions, to our body sensations in the moment, in real time. So like a present moment attention, things like mindfulness are very good at this as well. So that's a big part of my work, is just building the skill of noticing what's happening while it's happening, because then we can begin to work with it. Imagine a river, and the river can be calm, the river can be wild, and you're in the river. And when you're in the river, then you are going where the river takes you. So when it's cool, when it's calm and slow, you know, you have a nice little ride around the river, everything's good, feels nice. When it gets rough, if you're in the river, you're being battered about, chucked against the rocks, you're reactive, nothing you can do. We don't want to be in that position when we're trading. Where we want to be is we want to be noticing and observing, a bit like being in a helicopter above the river. And this is what present moment mindful type awareness gives you, is the river is either calm or rough still, exactly the same as before, but your experience of it is very different when you're above the river versus in the river. So the ability to be noticing the thoughts you're having, the ability to be able to notice and observe what you're feeling, and to notice the sensations in the body, but to notice them as thoughts, feelings, as sensations, is a really powerful skill around situational awareness. Likewise, that's the internal piece, situational awareness, what's going on externally within the market. And it's that situational awareness which is a key quality in dynamic decision making, where there's risk and uncertainty, which reduces as we become more stressed, fatigued, and overly emotional. So that's a really key skill. So I've been advising clients always to do that as part of the work of becoming a good trader, and maybe a bit more so, or to start doing more of that now where they can, maybe just a few minutes a day. Along with that, checking in with how you're thinking and how you're feeling. So, you know, taking time during the day, press the pause button and check in. How am I thinking and feeling right now? What thoughts are there? What emotions are there? We want to be able to notice them and observe them. If we are aware of our thinking and feeling and our sensations, we can be responsive from the helicopter view. When we're in the river, we are reactive. And a very simple process I get all of my clients to do when times are tough is what I call the daily download. This can be done at the start of the day and or the end of the day, and it's a chance to take 3 to 5, maybe 10 minutes to write down all the thoughts and all the feelings, can be about life and the markets and trading, and get it out onto paper. See them as thoughts, see them as feelings, but in a crude way, a bit like flushing the toilet. You know, if you're not flushing the toilet, it's building up inside of you. That's why physical activity is good, and we'll come to that later. You want to be moving well. That's a flush of the stress hormones through the body. We want to be journaling, the daily download. That's a flush of the mental and the emotional, so we can clear and reset. And again, that's important for responding versus reacting. Other things I've had clients doing, some of them we use HRV monitoring. So basically it's biofeedback. They wear a heart rate monitor and they each day check in and get their data, like I showed you with that day trader who had the declining numbers from the 60 down to the 26. So we're doing daily check-ins, you know, kind of what is the impact been, and then we can manage it as we need to. Alongside that, breathing and relaxation strategies, which actually increase HRV. So even when things are tough and the body's being a bit battered by the markets, we can restore it. And that's really about sleeping well, you know, getting good recovery, moving well, eating well, you know, things like caffeine and sugar. These can just exacerbate the stress response. There's enough of that already for some people. We want to kind of keep it cool, calm, observer, noticing, stepping back a little bit, being, you know, really being on, you know, above or on the side of the river and not being in it. That's kind of the real key goal for me. And that's a bit about kind of managing, I guess, the psychology and the physiology of the experience. But of course, in amongst all that, we don't want to be doing that for the sake of it. We're doing it because the goal of trading is about obviously maximizing returns from the markets for most people. We want to be in a state, psychological state and a physiological state that allows us to maximize returns from the market. So it's not just about doing the psychology stuff because it's the psychology stuff, and likewise the body stuff. We're doing it to enable us to take effective trading action, functional trading behavior. And that's functional based on the person, the goals, the markets, and their strategy. So it's unique for different people. But for example, one of the key things is the focus always in trading and should still be making good decisions. So that's a combination of profit maximization, so trading big enough to maximize profit, balanced with trading size that's appropriate to allowing you to execute your trades effectively. The danger is in high opportunity moments is people take too much risk to maximize opportunity, and it has an impact on the execution of their trading process, and that can end up with some pretty disastrous results. So we want to always balance what's the size that allows me to optimize the opportunity, yet also allows me to execute my process with minimal interference psychologically or physiologically. Preparation's been a big part, I think, for people. So, looking at scenarios that might happen, if then, so, if this scenario happens, then I'm going to do this, having multiple scenarios ready. And one of my clients, we had this as a Sunday practice, so on a Sunday evening, looking at the days and weeks ahead, scenario analysis, and what he would do in those scenarios. And he has been very successful over this recent few weeks. And he puts a lot of that down to that hour or two spent on a Sunday evening doing the scenario analysis, but not just what if, but also the if then, and also looking at worst case scenarios, and also being willing to assess and update that preparation during the course of the day, and obviously from day to day, not doing it on a Sunday and then it's done for the week. It's done on a Sunday, reviewed on a Monday morning, reviewed during Monday, ongoing, because obviously everything's dynamic, it's updating pretty quickly. Something else I've said to a lot of my clients, and this is really one of my favorite techniques, is just thinking about who you want to be during this time. What strengths and qualities do you want to demonstrate as a trader during these times? Is it about, is composure important? Is it about, taking opportunity in these key moments? Is that the quality? But really think about, who you want to be in these moments and what actions would reflect that. And it kind of, why it's valuable is because, without going into too much detail, it anchors you into a being, into a quality of being, which happens alongside the doing. And most people give very little thought to how they want to be while they're doing whatever they're doing. And it's key. And actually, when you focus on how you want to be, in the short term, it reduces the stress response. In the long term, it builds resiliency, but it also, in that moment, guides you into taking action that's driven by an intrinsic factor rather than something that's external. So really powerful. And then finally, I think on the practical side is just being mindful of risk management. Two types. First of all, position sizing, so being mindful of, as volatility is increasing and uncertainty is increasing, that's increasing the stress response in the body already. So to balance that, it might be necessary to reduce the amount of financial risk, because if the financial risk is high and the market risk is high, then it can mean the behavioral risk, the chance of you making an error, becomes equally high, or becomes higher. So we want to balance it out. So it's that continual kind of, and these are judgment calls. These aren't algorithms doing this. About just looking at what's the volatility, the uncertainty, what's the market opportunity, what's my physical state, what's my mental state, emotional state, and what feels right risk-wise accordingly. So being flexible with the risk taking, not being stuck to a certain size or trading big just because the mind's telling you it's a great opportunity and you should be nailing it. And this is an example. This is from one of my clients that we worked through this probably about 10 days ago. We were having a quick coaching discussion, and he was talking about how he had been aware that toward kind of coming out of the real kind of peak volatile period in those first few days, he had noticed that his P&L, his profits had hugely increased, they're exponential. He was making more, multiples of more in a few days than he made in the entire year before. So, significant increase in P&L, so huge returns. He noticed that. For him, one of the things that we've worked on is overconfidence and the danger of becoming overconfident. and the cost to that, and they can be really high. Overconfident, high risk taking probably causes more bigger losses than anything else. So he had noticed in his language and his thinking that his confidence was beginning to increase to an unhelpful level. He was becoming aware that fatigue was setting in, and he'd even started to get a little bit kind of run down, you know, a little sniffly nose and so on. So he was aware that his state was reducing. Through his analysis of the market, through his daily analysis of looking at market conditions, he could see, or his assessment was, that the market opportunity was decreasing. Now, this is like warning lights on the dashboard. Hugely increasing P&L, high levels of confidence bordering overconfidence, fatigue setting in, market opportunity decreasing. Now, without that awareness, and what he did was actually he took a step back. So he took a step back, he's been a bit more cautious and careful with his trading, navigated it through in a slightly different way. But without that awareness, it would be very easy as a trader to keep trading, you know, using that big pile of P&L, just, you know, loading that up against, you know, the next positions, leveraging all that money you've made, getting overconfidence. You know, the fatigue sets in, mind and body, now you're working for shortcuts, not making good decisions, the risk is high, risk of error is also high, and that could be an absolute disaster. And I'm pretty sure we'll hear about some significant losses that people had that we can probably attribute to some of these factors, you know, as we get out of this situation. So that behavioral risk management is a really key factor, and it's something you can all do for yourself. You know, you've just got to think about, how am I going to check in, you know, what are the factors for me where I know my trading decision making starts to, you know, deteriorate, and how can I monitor progress towards those? You know, how will I monitor it kind of psychologically, thinking and feeling? How will I monitor it in terms of fatigue or stress in the body? How can I monitor it in terms of, you know, the market conditions? And how can I monitor it in terms of, you know, other factors like, you know, maybe having, you know, increasing P&L, or those, you know, kind of timing factors, you know, end of a week, end of a month, particular data releases, and so on. So that's a really nice piece to put into your trading. So not just about managing financial risk, but also managing your behavioral risk, because financial risk is really a consequence of behavioral risk. You know, if your behavioral risk management is good, you're going to lose less in the market and you're going to make more. Lose less when it's bad, make more when it's good. If your behavioral risk management is bad, then your financial risk management, you know, that's the secondary form. And most people in trading are managing financial risk and not enough of measuring or monitoring or taking care of their behavioral risk. Cool. I'll try to read through that, Simon, in half an hour. I'm hoping it wasn't too fast for people. It gives people a flavor to think about.
Thank you. Just interesting to hear how these things, I guess, do really impact people's trading. It sounds, sometimes you think, wow, will it really, you know, have an impact on me? But I mean, my own experience of this lockdown is that I have started doing these daily workouts. This Joe Wicks early morning work, and doing it with my 10-year-old son. And yeah, I feel the difference on the whole day, on my whole working day, not necessarily just the trading, but just the whole approach to things. So there's a lot to be said for the sort of healthy mind, healthy body, healthy mind. It all sort of tracks back to that. One of the questions from Lucas says that, do any of Steve's clients experiment with microdosing? I've never heard of microdosing, but does that mean something?
Yeah. So microdosing, just so everyone's aware, really is one of the trends. So we could break it into kind of, how can I improve my trading performance? We could go kind of obviously, you know, let's call it kind of the basic trading stuff, the craft. We could look at, you know, what can I do psychologically? What can I do physiologically? What can I do technologically? You know, how can I use technology to improve my performance? And then in recent terms, relatively recent terms, people have been trying, let's call it pharmacology as an enhancer. So how can we use drugs, you know, obviously legal drugs, in some way to improve performance? And one of the ways of doing that is things like with LSD and with other substances, you can microdose them. So you take a very, very small dose over a period of time to get kind of off your lower effect, but kind of like a marginal gains impact over time. So I would say I'm aware of some of my clients who do utilize that. I've got a few, particularly in the US, some clients who are very into kind of the kind of general term is biohacking. So they're very into hacking their biology through things like microdosing, through particular routines and habits around obviously nutrition, nootropics, which are kind of smart brain drugs, also kind of a pretty recent trend. So so yeah, so people are doing that, and I think, you know, under these extreme conditions, things like nootropics potentially can give someone an advantage, because they can give us that burst, mental burst that maybe we wouldn't be able to get normally. So yeah, they definitely are being used, and probably my guess would be possibly slightly more recently than maybe under normal conditions.
I can imagine. Yeah, I mean, interesting you say, you know, dealing with the possible pitfalls of being overconfident after having a good run in the markets. All these things come to bear. I know we've just run out of time a little bit. Can we talk about the courses? I know you're doing an online course in conjunction with the technical analyst guys. I've put the link to that course in the chat box there, and I know you've said that if anybody wants to join on, they can get a £100 discount if they use this code RTCT Web 100, which is great. Just maybe if you could just touch on what you'll be going through on the course.
Sure. So here, in a nutshell, basically it's very rare, probably only 2 or 3 times each year, that I deliver any kind of training or do anything outside of my own kind of client's wall. So it's a nice chance to share some of the things like we've talked about today, but obviously in a broader context with people outside of my normal institutional clients, and obviously globally. It's a 6-week program. It's 1 webinar each week, 60 minutes long. There's a key theme, so we're going to look at trading process, making good decisions. We're going to talk about personality, and people can take the risk type compass personality test and look at their kind of risk profile. We're going to look at developing psychological flexibility, how we can manage the mind effectively, how we can manage emotions, develop a mindset that's conducive to trading. We'll look at the physiology, about managing the stress response and energy, and then we'll kind of put it all together to look at how we can apply it obviously in the markets day to day. The sessions are recorded, so they're delivered live between, I think it's 11 and 12 UK time each Monday, starting on the 20th of April. They're recorded so you can view them again. There's going to be obviously a workbook to go with each session, and there's some exercises to do between the sessions. There's some mental training audios that we're going to give away as well as part of that. And people can also ask questions in the webinar. They can email questions in to me if they can't attend live. And yeah, I think that's pretty much it, really. It's just really, I mean, I would say it's not for beginners, because I think if you're a beginner, the main thing to do is get good at the craft, get good at the trading skills, get the knowledge. But I think if you've been trading for a while, or you're serious, and maybe 2 years or more is probably a good guideline, and you want to kind of really get a deeper dive into the mind and the body part of trading, then it could be for you. And Simon, as you said, I think it's 895 is what they're charging the course. That I've got a partner who's kind of running it, and we're doing that £100 off for your RTCT clients. So yeah, that's it. And if you want to find out more, I think Simon's put the link, and you can see it all there.
Yeah, you know, I'll send an email out as well of this in a few days as well, so everybody's aware of it. When does it start? When's the start date again? Is it 20th of April?
20th of April, Simon. So a week on Monday.
Week on Monday, so we'll get something else to you if you missed the links, but that's where to go, or just contact me. Steve Ward, thank you. Always a pleasure to have you on. Thanks for giving up your time, and have a nice Easter weekend.
Yeah, Andrew, thank you, Simon. Take care. Thanks, everybody. Bye-bye.
There we go. So my thanks to Steve Ward, Performance Edge Consulting. I'm going to go back to my screen, and I'm going to give my apologies to Sunil Mangwani, who's been waiting patiently. We've eaten into your time. Sunil will add a little bit of time on to the end. Your microphone is unmuted, so good afternoon, and I think it must be early evening for you, is it, over in India?
Yeah, good evening from here, Steve. How are you doing?
We're very well, thank you. Very well. So always one of the things of these multi-speaker events is that inevitably we run out of time, and there's a bit of a knock-on effect. So thank you for waiting patiently. We've had a great attendance today, and I know you spoke last week very well, and a lot of people said, look, this is great. We'd like to hear just a little bit more. In particular, the mention about the stop losses and the strategies that you had there. So we're hoping you could just expand on that. Shall I make you the presenter, and we could go across to your screen?
Oh, yeah, absolutely. Let's start. So, can you see my screen?
Yes, we're looking at the slides now. If you want to maximize that.
Yeah.
That would be a bit easier to read. So fantastic.
There you go.
Okay, well, as I say, we've gone just over 10 minutes or so into your time, so we'll just get straight into it and tell us where you'd like to pick up.
Okay. All right, folks. So, well, hello again. Welcome back. Good to be back here again. And as I had spoken last week about this particular thing, I'm just going to go over the very basics of what we spoke about last week. And I had promised that this week we'll just go over the charts. We just go over the trading part of it. Let me give you a little bit of background, because what we're talking about is risk management more. And what I want to do is get the risk management into the method part of it, into the technique part of it. How do you use proper risk management on what kind of techniques you're using? Taking that into account, just a little bit of background about the Forex market, which we went over last time. I've just reduced the slides down from the last week. So huge turnover, two little known facts. One is that almost 70% of the trading done in Forex is done by banks and institutes. This is a slide which I shared last time. So about 65% of the entire Forex trading is done by a group of 10 banks. The second important point is almost 70% of the entire trading done today, of the 6 trillion, you can call it in a day, roughly, 70% is non-deliverable, which means it's traded for speculative purposes. So about half of the trading done today is done for speculative purposes. And if it's done for speculative purposes, you have to ask yourself, obviously it's the banks who are doing most of the speculative trading. What do they trade on? And there's a reason why I'm going over there. Do they trade on technical analysis? Do they trade on fundamental analysis? Well, it's a bit of a combination of both. Banks are the market makers. Everybody goes to a bank to change currencies. We are just talking about the currency markets. But along with taking orders for their clients and trading on certain fundamental factors, keeping a watch out on the economic numbers, everything, they're bank traders, they have to do that. The primary decision is taken to take out the stops of the retail traders. Retail traders, individual traders like you and me, we are fish bait, literally bait, I would call it, for the big traders. And in Forex, this becomes very important because when you are trading, you need to know who's on the other side of your trade. As an individual trader, as a retail trader, when you're trading, most likely the other side of your trade is going to be a bank. So this is a background about going into technical analysis, how this is going to affect your trading. Then most traders tend to lose money because they don't follow the concepts of 3 M's, which we talked about last time. Your money management, that's your risk, your mind factor, the method. We had the other speakers over here, and I think you would agree that everybody agrees with just one thing, that it's your mind factor and the other risk management which are more important than your trading. And they say that if somebody asks me that where's the market going to go tomorrow? Is it up? Is it going to be down? I don't know and I don't care. What I'm looking for is my trading opportunity. That's what we're doing as retail traders. I call myself as technical trader. I look at the charts, I see an opportunity, I'll take the trade. And my trade is based into taking into account my risk management and my mind factor besides the trading methods. Now, let's just concentrate right now on the risk management part of it. Risk management simply means protecting your capital. It's simple mathematics that if your losses are small and your profits are medium to large, even small, your account is still going to grow. But again, simple mathematics, if your losses are large, your account is not going to grow. So protecting your capital becomes important, and this is where your effective stop loss techniques come into place. So what I'm trying to do over here is look at the importance of risk management, but going into technical analysis and taking into account that there is somebody out there, there's a big boy out there whose only job is to take out your stops. Combining all of this, how can we make an effective stop loss technique. This one slide which I would like to share. It's not mine, of course, I picked it up from the internet, but it really describes absolutely well what the banks do. Let's call these banks the professional traders. They could be banks, they could be institutes. So simple fact is, which I had discussed last time, most retail traders use technical indicators which are lagging. They would also use Fibonacci numbers, but simple fact is, if you know a Fibonacci, even the professional trader knows that. And he, the professional trader at the bank, has got enough capacity. He's got enough of money to move the markets. So he can drive the markets, believe me. Now, there's a difference between manipulating a market and moving a market. The banks can move a market. They have the money to do that. Taking this into account, it's a simple fact. You look at this slide, there's a support level. Price comes back to a support level. A lot of traders will tend to go long. What the banks will do is they will drive price down. And the cluster of stop loss is the fish. As I said, we are fish bait, right? They know exactly where the stop losses are going to be. They will drive price down, take out all the stops, and then price goes up. Look at the logic about basics of trading, right? When you buy, let's say I'm buying over here. I'm a retail trader. And at this support level, when price comes back to this support level, I place a buy order with my stop loss somewhere below here. When I place a stop loss, obviously it becomes an opposite order. If my stop loss is triggered, it becomes a sell order, right? What's happening over here when price is driven down? My buy order becomes a sell order. This sell order is taken by the banks. If the sell order is filled, that means somebody is buying it. The banks are there to buy it. So they will drive price down and they will place large orders to buy it, which is where your trend starts. Now, coming back to this, if I just look at this one, this is the base of all the techniques that I tend to follow. Again, I'm getting with the, okay. Do I have it? I still don't have it. Anyway, it doesn't matter. If I look at this low and this second low, this is what creates a divergence, literally. So, take a pen. Nope. Anyway, this lower low creates a divergence. Now, the divergence is the prime reason of my main technique, which of course I've developed it much further, put in a lot of rules to it. But this is what creates a divergence. What I want you to understand is taking out the stops creates something what we call as a divergence. Now, on a chart, this is exactly what I've put it down on. So as you can see, there's a support level. I've put a green band over there. At this stage, if I was trading the hard right edge of the chart right over here, as soon as price comes to support and starts going up, there'll be a lot of traders like me, a retail trader, who would buy. The banks would move price one down, and this divergence, as you can see, is shown on the indicator. I have a simple stochastic over here, so you can see it on the indicator what a divergence is. Effectively, a divergence is something which I firmly believe in. Again, it's a very personal thing, but if you look at a chart on any time frame before price changes trend, you will most likely 90% of the time find a divergence, because this is what creates the movements. It's what we call as the law of the charts. The law of the charts looks, if a price changes trend, there has to be a taking out of the previous stops. There has to be some large orders coming in, and this is what creates a movement. So going over this, I'm taking one more example. This is a live trade and just recent trade. I've deliberately put this over here because as I said, I'm going to show you some trades over here. So as you can see, this price made a low and a lower low. There was a buy. I had placed an anticipatory buy order. And what happened? Price went up exactly to that target. If you look at the target, I had the target level right here, right there. And this was a stop, buy stop. I didn't even have time to manage the trade. It got filled, it went up. At the end of the trade, at the end of 7, 8 hours, 10 hours, I look at my account and say, hey, good, I made some money. Doesn't, of course, necessarily work this way all the time. There are losing trades also, which is part and parcel of trading, but this is exactly what a divergence is. So one stop loss technique is, simple fact is, if you see a support where everybody's looking at a support, well, everybody's going to get stopped out and so are you. So take into account, keep this factor in mind, that what is a professional going to do over there? Once you start thinking like a professional, it automatically puts these techniques into your own trading system. So the divergence is one of the most effective trading systems, again, because it works on the basis that the stops are being taken out. Now, we spoke about the Fibonacci's, and this is one thing which I want you to go over. If you remember in my last session, I had taken this chart on the GBP CAD in the 4-hour, and I had specifically said I'm keeping a watch on this, and this is a trade that I am planning to take. I took a trade. As you can see, I have a sell order right over here, but before that, let's just go into this. What I wanted to show you was Fibonacci levels, trap levels, stop loss techniques. The 61.8 is considered to be the golden mean. Everybody follows the golden mean. And as I described last time, it's a golden ratio. The reason why it works is because it's mass mentality. Everybody's looking at this level, the banks, the retail traders, everybody. As soon as price reaches over there, there's bound to be some reaction, for the simple reason that if I'm plotting my Fibonacci's here, so in this case, I'm looking at a 61.8 to act as a resistance level. That's what we do for retracements, right? So as soon as price finds some resistance at a 61.8 and you have a couple of bars going down, a lot of traders, retail traders, will jump into a trade and take a sell. Because of 61.8, hey man, that's a golden ratio, right? It's a very important Fibonacci level. So I'm going to go short. The banks know that. Now, if you know it and I know it, obviously the banks know about it. And what is their job? Again, I repeat, their job is only to take out the stops of the retail traders. What they're going to do is they will drive price up only to take out the stops which are kept above the 61.8 in this case, and they will drive price up. Now they will drive price up to a 78.6 level. Why 78.6? Well, as I said, dealing with the banks, I had talked to them. The only deduction that I could get, and I think it's logical, is that 78.6 mathematically is the square root of 61.8, and it's close enough to 61.8 so that the stops get taken out and your trend can start. Sounds logical to me. I'm not going to go into the whys of why it works, but it does work. So banks will drive price to a 78.6 level, and then your actual trend is going to start because that's where your stops are taking out. If you ever see, and I had at my closing last time, I had mentioned to everybody that do an experiment. Go to a higher term time frame charts, 4 hours, dailies, weeklies, works on small time frames also, more effective on larger term time frames. Just keep plotting your fibs, and 78.6 is not an inbuilt level. You have to add that level, which I did for my MetaTrader, 78.6, add it, and you will be surprised at the number of times the price stops dead at a 78.6 before it changes trend. As far as I'm concerned, the 78.6 is a much more important level than a 61.8. Now, what happened to this trade? Price came down. My first target was somewhere over here. So what I did was, when price moved down, trade management, which is an important part of trading, which is what we always teach. Any trade that we take over, we have a trade plan. How do you manage the trade? I moved my stop to my break even, to my entry. At this stage, I was in a free trade. When price reached over here, my intention was to take off 1/3 of the lots, let the balance go down. My target was down over here, which is the 78.6 now of the support. If I plot my fibs from here to here, from the low to the high, this target was my 78.6. So I made some money, in the sense my stop was at break even. But what happened here? When price came and stopped at one particular level, I saw a bullish divergence. Can you see this? Price did stop here, and your stochastics were giving a divergence, started going up. This was a way I closed the trade. It was yesterday, somewhere about yesterday, because I didn't want it to open over the weekend. And if it starts going down again, I can still re-enter the trade. Let me take my money. So I closed the trade, but I made profits from here to here, and I was at no risk at any time. The reason why I'm showing you this was the importance of Fibonacci levels. All the Fib levels that we talk about, when we do our course, when we talk about the different Fib levels, each and every Fibonacci level has got a purpose to it, has got a reason to it. 78.6, of course, being the most important one. This concept works on any time frame. Let me show you something. This was a daily time frame on the Canadian dollar. Now, this is a harmonic pattern. It's a Gartley. For those of you who are slightly familiar with the harmonics, there's a Gartley, there's a butterfly, or there's a crab, there's a bat, and there are lots of patterns. People tend to make the harmonic patterns very complicated. For me, it's a very simple thing. It's an interplay of Fibonacci levels. A Gartley is nothing but the stops of the traders taken out at 61.8. Can you see this? Price stopped at 61.8, started moving down. A lot of traders would have gone short, and boom, one move straight up to a 78.6. If you do a search on the Gartley, this is what a Gartley is supposed to do. Your first reaction is 61.8, your second reaction is 78.6. This is a bearish Gartley. I've just put the harmonic over here just to show you that this is nothing else except an interplay of Fibonacci numbers. But what we're effectively doing over here is trading along with professionals at a 78.6 when the stops at 61.8 have been taken out. This was a daily time frame, and again, Fibonacci trap ratios. This is the 5 minutes. I'm just taking some trades which we had taken. I generally don't go too low on this, but just for demonstration, look at the effectiveness of this. Initially, price came up to 61.8, started moving down. A lot of traders would have gone short over here, and boom, one move up to 78.6. And as I described last time, if that move up goes with a lot of speed, with a lot of volatility, with a lot of volumes, because you really can't see volumes here in Forex, the possibility of a turn back from there is high. And look at the move over there. So effective stop loss techniques is nothing but understanding what a professional is going to do. How is he going to make his money? If you are on the right side of a trade, well, that's your stop loss, right? That's where you place your stops. Just as a matter of practical point of trading, let me just tell you, if I take a pullback, if I wait for a pullback, I will not take any trade unless price reaches a 78.6. For me, that's the most high probable one. And let me show you something, like I said on the charts, very interesting situation that I was following right now. Yeah, on my charts. AUD New Zealand. This is something, of course, it's almost coming to a close of a week, but I'm keeping a watch on this because I expect it to stop at the 78.6. Why do I do that? Because there was a reaction at a 61.8. Now the price is going up. Here you can see clearly, if you take it on the daily, it's on the daily as you can see it. If it stops at a 78.6 and I see some resistance happening, some patterns, my intention would be to go short with the target being the 78.6 of where I would plot my fibs from here to wherever it stopped, and that 78.6 would be the target for the trade. Will it work? I have no idea. But the simple fact is, the way we look at Fibonacci's, you have a plan, right? I'm not going to do anything till price reaches a 78.6. And this is just the practical parts. And this brings your mind factor of trading. I am not going to do anything on this currency pair till it reaches a 78.6 and maybe it'll give me a pattern on. I look at other currency pairs. If I don't have anything to trade today, I will not trade today. But unless I do not have the odds stacked in my favor, I am not going to trade. right? Now I have taken this particular divergence based on certain harmonic patterns, and I have, I wouldn't say invented, discovered a pattern, which I call the diamond harmonic pattern, which honestly is not available anywhere else. I have applied for a patent on this one. It identifies the harmonic pattern, it identifies the target. This is the alert, and this is real time, all right? This is real time. You get an alert. This is what happened on the CHF JPY on the 1 hour. I just run my indicator, I scan my charts, and it tells me, okay, this is my take profit right here. And then I get into a trade, and look what happened to this trade. Bang on, right up to there. I place my entry, stop, and my target, and I get out of it. It's just as simple as that. It's based on my experience of using the Fibonacci's on a different level to remain in the direction. On a live trade right now, I'm short on gold. This was a 4-hour pattern, a sell pattern on gold, which, to be very honest, the trade is not doing very good. It had come down, it's kind of going back towards my entry, but it doesn't matter. Losing trades are part and parcel. But this is what my target is. And let's see how it plays out in the next week. If we are around next week, if I have the time, then if you talk to me or you keep a watch on this, send me an email and tell me that, okay, Sunil, this trade worked out. Or no, Sunil, it didn't work out. Your pattern does not work. Well, whatever. Just kidding. But the whole point, what I wanted to discuss today was keep a plan, get your risk management in place, get your stop loss techniques based on the correct factors. You cannot have a stop loss as a simple, what I call as a comfortable dollar value, right? That I'm going to risk only $50 on the trade. The market does not care about your dollar values. The market respects technical levels. And if by the technical levels, if your stop loss is too large as per your rules of your risk management, well, do not take the trade. It's just as simple as that. Most important thing, if you follow your rules of risk management correctly, and if you have the discipline and patience, which I call as the mind factor, you could trade any technique. And believe me, even if you just look for reactions at 61 to 78.6, just that. I did an experiment with one of my students, and I told her, a lady student from South Africa, just do this. For 2 months, don't trade anything except a 78.6. And if you have price reacting at a 61.8 before going to a 78.6, you have a high probability trade. If you don't have a setup in a day, you scan 15 currencies on whatever time frame you want, 1 hour, 4 hour, maybe even 15 minutes. I don't like going down to smaller term time frames. And believe me, at the end of 2 months, it was a proven fact that her account has grown. Whatever system you follow, any technique that you follow, you could be trading with anything. See that your rules of risk management are in place. See that your psychology is in place. You have the discipline to stick to one. And I can assure you, your account will grow. People make money from trading. Most people do lose money, but people make money. And the people who are successful, the traders who are successful, simply follow a set of rules. That's about what it is. All right, as I said, short presentation today, but that's it. So any questions, let me know.
Thank you, Sunil. Thank you very much for coming back and doing again. Sorry, just get the phone going off there. Does anybody have any questions for Sunil on that thing? Yeah, press escape or gesture. Okay, that's the technical query. Okay, nothing coming in at the moment, which is great. So we've addressed all the questions there. Now, Sunil, we were due to be doing our workshop on Monday and Tuesday.
Yeah.
But
yeah,
I don't think we don't want to run it unless we've got enough people on it. If anybody's interested in doing the 2-day workshop with Sunil, please do let me know. here we go. We've got a couple of questions coming in now. With your wide and long experience, typically, which time frame is the most reactive from Jignesh?
As far as currencies are concerned, I would definitely stick to higher term time frames. From my experience, I would say that the 4 hours, very specifically, is a fantastic time frame. It's not too high on the daily. It's not too low. 1 hour and 4 hours, I would say, but 4 hours. The simple fact is, as I've said, this is controlled more by professionals, the banks. And do you think the banks trade on a 5 minutes and a 10 minutes time frame? They do not. They will trade on the 4 hours. They would go down to the 1 hour. So from my experience, 4 hours is ideal. That's what I stick to.
Okay, fantastic. Now, we've got a few other questions there coming in, but I'm conscious, Sunil, we've run over our time. It's my fault. We've just dragged on a little bit. And I'm keeping our final speaker waiting. So Paresh and Keith, I'm sorry. Please do email these questions in. Yeah, what I'll do is I'll forward these questions to Sunil on email, and he can come back to you if you will give me your email address. So I'm sorry, but we're just so pushed on time that I want to get to and say where else we. I will contact you again, Sunil. Thank you very much for joining us again.
All right, thank you, everybody. Have a nice day. You take care, and I'll see you soon.
Thank you very much, Sunil Mangwani. And again, we've got that 2-day Forex webinar workshop. If you're interested in attending that, please let me know. But we will go straight over to Patrick Munnelly, who has been waiting for me.
Hi, so how you doing?
Patrick, I see you there. Yeah, and again, sorry to keep you waiting. Where everybody just takes an extra few minutes, and the cumulative effect of that. So listen, let me go straight over to your make you the presenters. You are coming into us from FX Career Swap. I know, Patrick, we're doing a webinar tonight as well at 7 p.m. UK time. And we've got quite a few people booked up to attend. So great. So let's have a look. I asked you to come on and just tell people that you were coming back for this webinar, but also to just give us a little bit of insight into the markets and a little clue as to some of the strategies that you are using. So sure. I'm looking at your screen. Can everybody else see Patrick's screen? Okay, we should be looking at the monthly performance slide. If you can see and hear Patrick, just give me a little tap in the yes box. Great, Stephen, thank you for that. Okay, so Patrick, what are we looking at?
So I just thought before I get going, I'll give you a brief introduction to who I am and the context in which I'm coming to you today. And then I've got a couple of specific markets that I think are particularly interesting at the moment. A couple of live trades have just triggered. And so I'll walk you through the thought processes behind those. And then obviously, with respect to FX Career Swap, I'll cover more in detail about that this evening. So as a quick intro on myself, I've been involved in the markets for 15 years. Haven't always been involved in financial markets. I started out in the consulting arena and did a consulting startup that experienced some pretty rapid growth in the early noughties. And by 2005, I had exited the business, cashed in my stake, had some chips to play with and some time on my hands, and started what I'd call meddling in the markets, day trading the S&P 500 in a market that was just trending north. A trained monkey could have profited, and I did so, and I started to make some solid and then significant gains. But when the market underwent a correction, I was really out of my depth and started, as is often the case, averaging down, and ultimately took quite a painful 6-figure loss that really brought me to my senses. And it was a wake-up call that made me decide that if I was going to be involved in trading and so, risking my own hard-won capital over the years in the consulting game, that I really had to get serious about it and deal with it as a commercial endeavor and treat it as a business. So I sought out a mentor, someone who demonstrated excellence in the field. I modeled their behavior, worked with them intensively over an 18-month period, ultimately developed a trade plan, business plan, a fully back-tested strategy, forward-tested, and really during that period, the mentor that I worked with didn't just help me with my technical game and an understanding of markets and market dynamics and themes, etc., but really, most importantly, worked with me on my mental game. And so I became far more self-aware and a present individual by the end of that process, and came back to the markets in 2008, trading my own capital. And the reason why the performance is from 2013, that's when I started taking on external investor capital. It started with friends and family through a managed account service, which I've run since then. And since that period, it's grown organically. I've now got about 19 or 20 accounts that I manage, and it's a fairly meaningful chunk of change that I'm running at the moment. And these are the performance figures from that period, risk statistics, etc. And again, just from the outset, I think it's incredibly important in trading that you accept from the get-go that loss precedes gain. So for me, I'm no longer focused on the outcome of individual trades. I'm focused on my trading process, because I know if I deliver that and execute that with excellence, then over time, over an extended series of outcomes, I'm not talking even 10 or 20 trades, I'm talking about the next 100 trades, I'm looking for my edge to demonstrate itself. And fortunately, I've been able to deliver positive annual returns on my own money since 2008, and then the investor capital since 2013. But that doesn't mean that there aren't periods of negative feedback from the market. I can do everything right in terms of my setup and executing the trade, but each trade ultimately is a coin toss. And if you treat it like that, it takes away a lot of the heartache that less experienced traders have in terms of when they first get into the markets, and the pain of watching every up and down tick in the markets. I've got to a position now where I trade just the daily time frames in the Forex and the futures market. And really what I've learned over the years is actually the irony is the less time I spend looking at the screen, the more profitable I am. And so I'm fortunate insofar as that my days are pretty much my own. It's an end of day trading strategy. It's heavily automated now. It's certainly the trade management is automated. And so, I start to keep my finger on the pulse of the markets, but I'm certainly trying to spend as little time as possible involved in intraday timeframes, because I've realized over the years that it's these higher timeframes that certainly suit my personality better. Because other people, what I didn't want to do was give up a day job where I'd had success and then become slave to computer screens with respect to watching charts. So it is really, it's a lifestyle choice for me. All the strategies that I use could be implemented on intraday timeframes, but it's just not something that I want to spend all my waking hours doing. So in terms of my other projects, I'm a market expert in residence at Tickmill, an online broker who I highly recommend in terms of their platform, the stability, their execution is excellent. And I've been approached over the years by numerous brokers to provide market analysis, and more often than not, I've turned them down on the basis that they don't really stand up in terms of reputation from my perspective anyway. And so these guys do, and I work exclusively with them, providing them with daily analysis, a daily market outlook, and a daily setup that I'm watching in the markets. You can get onto, through their site, you can get onto their blog, and you can register to receive those updates. The other project that I'm heavily involved in is FX Career Swap. We're ostensibly a hub for emerging retail trading talent, who obviously the main issue for retail traders is that of capitalization. They can have a great trading plan or method, but ultimately what happens is retail traders tend to become frustrated with limited financial gains. If they do get better financial gains, that tends to come from taking too much risk versus their account size, and they ultimately end up blowing up. So this is something that we've been working on now for nearly a year. We've got 80 really excellent, like-minded individuals involved in the team now, who are all moving towards the goal of ultimately becoming funded by us on a profit share basis. And certainly overcoming that hurdle with respect to capitalization. We have an excellent education program and support team in place. But anyway, I'll talk more about that this evening. What I want to get onto now, as I don't want to hold you up too much longer today, is there's a couple of market opportunities that I've been involved in, and some that are about to develop. Obviously, we've all sat through or been witness to the market action driven by the horrific global pandemic that we're all living through. The human cost aside, you know, my job is ultimately to trade the markets and to find edge and see where opportunities emerge. And one of those was with respect to, I do a lot of work off the charts with respect to seasonalities and flow and positioning in terms of markets. And this was a seasonality idiosyncrasy that cropped up here with respect to April in the S&P being the best month of the year. In the past 20 years, it has been the best month. And specifically when March is lower, and obviously March was significantly lower this year, in the past 12 instances, 10 of those have seen the S&P end higher. And so that led me to look or to start thinking about getting long the S&P. Another interesting data point, and this was the day that I initiated, or started to initiate my position, was that insider buying had spiked and had exceeded that of 2008, 2009 as we were heading into that March 23rd low. We also got the move index as well, also spiked above or towards 2008, 2009 levels. And on prior instances, we've seen certainly tradable bottoms. I'm not calling the bottom in markets. I didn't call the top, and that's not my game. What I'm looking for is definable edge and an opportunity. I know that historically we can see bear market rallies, even in bear market. I mean, ultimately at the moment the S&P looks like we could be heading back into bull market territory, unbelievable as it is. But we can witness these bear market rallies. This is a note from Goldman here highlighting the bear market rallies that we saw in 2008, the last certainly significant financial crisis that we've been through. We saw 19% there in a 5-day period. We've exceeded that now in the current cycle. And I did pick out an interesting note from or a presentation by Double Line Capital, Jeff Gunlack, where they looked at historical overlays. And certainly it would appear from a historical overlay perspective that we're looking like we're tracking price patterns last seen in the 29 crash. Everybody's talking about, are we going to retest the lows? And in the 29 overlay, if we are tracking that pattern, we didn't retest the lows that year, but ultimately we got a reaction high that sent us lower for a couple of years. Are we heading into a Great Depression? I don't know that, and I don't think anybody really does. And it's certainly in terms of markets, anyone who speaks in terms of definitives, who tells you they know what's going to happen, run a mile from, because nobody does. The market by its nature is ambiguous, and we're just trading or looking for edges to trade off. One thing I did note was that we saw a significant uptick in selling. This is data from Goldman Sachs Prime Brokerage. We saw this selling really uptick at the beginning of April, and I think that's what's driven the squeeze we're seeing higher in the markets at the moment. So if I pull up the S&P, bear with me. Hopefully you can see my chart. So the trade I had was into that low, the 23rd. I learned the guys in my trading team, the guys I manage for FX Career Swap, that we had a buy signal. I took the trade, got great risk reward on the trade by using an entry strategy which allows for some consolidation after the daily close, and then getting the risk reward ratio that I needed to give me. I took 200 points of upside out of the S&P and cashed out just before we saw the pullback. Now this pullback is giving us another setup at the moment, and one that I put in the Tickmill blog today, but one that I want to highlight. So this is what I call the reaction low, the panic low, and then we have the initial reaction high, which was what I was trading for, and now we've got another setup developing. So if we use this leg here and we overlay it versus our current low, which was the 29 area, this gives us a couple of targets on the upside that I'm going to be watching very carefully now. The green line represents an equality swing. So this is, if we look at this leg and we overlay it, let's just draw this in so you can see exactly what I'm looking at. So we overlay that leg there, you can see that's an equality swing that gives us this target area. And then what I look for is some confluence in terms of just some basic fib retracements, nothing fancy. The areas I look at are the 50% and the 78.6% retracement. Now here, the confluence zone is about 90 points wide, but we've got these prior structural lows here in terms of market structure. So what I'd be watching for now, certainly what we want to think about is we're coming into a holiday weekend. We've seen a decent melt up, and it's likely or probable certainly that if guys are long here, that they're not going to want to sit through the potential of any weekend gap risk. So we could see a reversal today in and around this 2790 to 2880 area, which may present an opportunity, certainly a short-term opportunity. But if for whatever reason we don't get any short covering today and this thing continues higher, then the next upside objective for me would be up into the 78.6% retracement and the 161 extension of this AB leg. So if I don't see a reaction here, then the next area of interest, I'm not looking to pick tops, I'm looking for specific confluent areas, and then I'm watching for the price confirmation. For me, the price confirmation, I have an indicator coded that basically gives the volume weighted average price, and when price is trading above a 5-period volume average weighted price, the candles are colored green. When they trade below, they're colored red, and those are the signals I'm looking for. So if I see a reversal, it looks unlikely if I look at where the VWAP is at the moment at 2651, it looks like we're probably going to melt up higher. So there's nothing for me to do. This is the great thing of having the strategy more automated, is I don't need to be sitting here glued to the chart, see what's going to happen next. I have some specific levels, and then I can just check in with this periodically and see where we're trading. You'll see that if we don't get a signal here, then the next target zone for me is going to be up towards this 3150, 3130 area, or 3170, 3130. Got these prior lows from a structure perspective here as well. We take out this level, and then all bets are off. And I think, you know, unbelievably, we could certainly be re-challenging these prior swing highs and maybe moving much higher. But the key decision point initially is going to be this area for me, and this is what I'll be watching as we head into the close tonight. Let's see if we get a quick de-risking in the market that we could see a sell-off develop. But if we don't see anything here, then my next target area for the S&P is going to be up towards this 3130 area. So that's one market I'm watching today. The other one that's really driving or has my attention is the dollar. Obviously, the dollar index is responsible for or is a counterparty in 60% of the world's currency trades. And we can see that there's a level of cyclicality in the dollar index. This is going back to the 80s, whereby we've seen these cycles of 6 to 7 years up cycles, and then 9 to 10 year down cycles. We've slightly exceeded that with the current upswing, but that's probably driven by the central bank intervention that we've seen that has driven this bull market that's exceeded all private bull markets, or had done, with the 11-year move. And we can see we're reaching an inflection point here with respect to the potential for this cycle, this cyclical move in the dollar to change. Now, what could drive that? Well, we're getting a vast amount of liquidity being pumped into the market to basically support or to facilitate the current drive we've had for dollars. And that's been driven by emerging market debt. They're having to recycle that debt, and they're having to clamor for dollars to do that. But the Fed have, once again, like they did in 08, 09, have thrown their hat in the ring and said, look, we don't want this game to end, and we're going to, we'll flood the market with dollars. There's a lag between that liquidity entering the market and a potential reversal in the dollar. But certainly from a thematic level, as a trader, I want to be cognizant of that, because that's, if I'm looking to trade the big structural changes in markets, then this is something I want to be aware of. This is an overlay by Goldman Sachs. This is showing 16-year cycles in the dollar index right back to the 60s, and you can see that we've tracked these 16-year cycles pretty well. Obviously, we've seen a move back up, but as we saw back in the dot-com bubble, once we hit that 16-year cycle, we rotated around the levels, and it's similar here in the mid-80s before seeing the sell-off. So where we get these what I call phase transitions, we tend to experience a bit of volatility before the move takes place. But as a trader, I want to be aware of this, because once the move does start to take place and I get some signals with respect to that from the nearer term technical setups, I can juice those trades to really maximize maximize my gains. The other thing we should be aware of at the moment as well, two things. One, we have a seasonality issue, or a seasonality perspective in the dollar. Going back over the past 20 years, the dollar's tended to see a peak go at the end of March into April, and then has tended to trade down, certainly into the beginning of May. And then any pop we see from the beginning of May has historically been sold in the summer months for a lower low to develop into the autumn. So there I have some seasonals. I want to have that in my, on my radar. And then I'm looking at positioning. This is CFTC positioning, going back to 2010, and the orange line is speculative positioning in the futures, while the white line is actually the dollar index pricing. So what jumps off the chart to me here? Well, I can see I can see divergence here with respect to when we last saw the meaningful high in 2017 in the dollar index. Look what was happening from a positioning perspective. On each new high, speculative traders were using that high to exit dollar long positions, okay, and or initiate dollar short positions. Now, what's happening as we're trading into this current high, we've got a similar dynamic developing. Each time we're making a new high, these guys are using that strength to unload dollars, okay? So that is, that's from a flow and a positioning perspective. You can see that this current dollar squeeze, this funding squeeze, this dollar stress could be potentially starting to come to an end. So where does that leave me in terms of trades? Well, the dollar index, this is a chart I've been sharing with the guys in the live trading room. Whilst we hold, this is the Dow Jones dollar index, by the way, but this is overlaid with my indicators. I can't do that on the DXY, but I said to the guys, once we held this level as resistance, we've got the potential for another leg of downside. We had a signal earlier in the week, and that signal looks to be playing out now. In terms of immediate trades, I'm long now the euro, and again, using the near-term volume weighted average price to signal the near-term change in money flow. And what I'm looking for, just similar to the S&P that I showed you, is an equality swing. So when I put a trade on, I'm not sitting there thinking, right, I'm going to make 10,000 pips on this. I want some level of realism in terms of what's possible in terms of market swings. So I use prior swings to guide me as to where price action can go. And if I'm looking at the idea of equality here, whilst we hold above this 107.60, it's logical that we could see at a minimum this 1280 area tested. And then if we bring in again the fib retracement tool, just to see if we've got any additional confluence at that level. Well, that level also coincides with the 78.6% retracement. So there's a cluster there. So whilst we hold above these lows, from a risk reward perspective, all I'm risking is the low of this prior day's candle. So it's it's just under 100 pips. But my upside here is potentially 350 pips. So I'm always focused, no matter how good the setup is, I always want to pay attention to the risk reward ratio. And so on this trade, I can get a risk reward ratio of 3.65 to 1. The other trade that I'm in is this one's just triggered as well. So this is the Swissy, oftentimes trades inversely to the euro. I've got a double confirmation here. I had the bearish outside reversal candle, which is my signal. And then I got the consolidation during the overnight trade, and I've just been triggered into this now. And I'm looking for a move down to test again the A, B, C, D equality move, puts me down towards 94. And again, from a risk reward perspective, that gives me a 4.1 risk reward ratio. So this is, in terms of going back to to my results from the beginning here, how my strategy ultimately works. And one of the key elements to focus on is my average winning month is 8.1%. Okay, my average losing month is 2.5. So I've nearly got 3 to 1 in terms of my average winning months to average losing months. And if you extrapolate that down, you can see how that feeds into my trading, where I'm looking for these 2, 3, or 4 times risk reward setups. So really focused now on this dollar index. There's another setup that I've got potentially developed. Well, it's triggered now. I haven't got this trade on, but this is the Sing dollar. I share a bunch of these trades on TradingView. You can follow me at FX Career Swap. I try and update them as much as possible. I'm able to give the signals, but because of other commitments, it's not always possible for me to update them as much as I'd like, but I certainly try and share ideas on there so you can get a sense of the strategies and how they work. But in terms of the Trade Pro team at FX Career Swap, they are obviously access my trading in a real-time environment where I'm giving the setups in advance and giving the trade entries, exits, etc. So, so in a nutshell, that's what I'm looking at. I'm looking at these S&Ps potentially squeezing higher into that first resistance zone that I'd be looking at short setups, and I'm currently positioned short the dollar. Is this going to be the actual turn in the dollar? I don't know, but I'm certainly aware of the fact that we could be starting to see a more structural shift in terms of the dollar index, and I see that opening up great trading opportunities across the FX majors. So that brings me to, I guess, the conclusion here in terms of what I wanted to share with you. Simon's brief was to make it short and snappy, and I hope it's been that.
Thank you, Patrick. Yeah, indeed, and we'll look at some of these trades again later on this evening on the
on this evening I'll share much more information with respect to what's on offer from FX Career Swap. I wanted to give you just a feel for that, but actually look at some real-time opportunities as well in the market at the moment.
Fantastic. Well, I'll put the link for anybody who's not signed up. I know we've got quite a good number signed up for tonight already, which is great. If you're coming along and signed up, thank you. If you haven't yet, and you can spare us another sort of 45 minutes or so this evening, 7 p.m. UK time, myself and Patrick will be back, and that link just gone into the chat box there. That's where to get yourself signed up. So Patrick, thank you for that, and yeah, we'll look forward to speaking to you again in a few hours time this evening.
Great stuff. Thanks very much.
Okay, great to hear from you. Take care.
Cheers, Simon. Bye now.
There we go. That's it. Our 5 speakers. I'm glad you joined me for today's working lunch. It's been a little bit longer than normal, but I guess we're not dashing outside, are we, these days? So I'm glad you decided to spend a few hours with me today. Maybe I'll speak to you again later on this evening. Otherwise, I will email you some details of these events and offers that the speakers are talking about today. So in the meantime, if we don't speak until next week, have a lovely Easter weekend. Obviously stay in, stay safe, and I wish you all my best. Many thanks indeed. Bye bye for now.